The amount of downside has probably been less than anyone would have expected.
The market is being very calm about this whole situation.
The drawdowns in equities were not as great as you would expect.
The market is trying to understand what is likely to happen.
Right now, the market is expecting a soft off-ramp.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning, live from New York. This is Bloomberg Surveillance. Welcome to Whipsaw Wednesday, a two-week ceasefire propping up risk assets around the world, sending oil prices tumbling, the most since the pandemic, with Iran saying traffic can go through the Strait of Hormuz, however, with caveats. Analysts searching for the details of the agreement to understand how quickly shipping can resume. The move in markets has been sharp, but not enough to erase the losses since the end of February when the war began. The bounce back absolutely violent and immediate. Russell 2000 leading the charge, up 3.6% in pre-market trading. You can see NASDAQ futures also outperforming at a 3.4% gain. When you take a look at what's going on in the bond space, pretty much across the board. But before we get there, let's also talk about how much it's really a global story, in particular with the Kospi completely surging on the heels of an expectation that you can get that risk on field, particularly in Asia, up 6.9%, the Nikkei up 5.4%. In Europe, rapid response with the DAX up the most going back to 2022 if this holds up 4.5%. The bond space helping to fuel this. Concerns about rate hikes just easing away as people take a look at the potential inflationary pushback. Two-year yields in the U.S. falling 5 basis points to 3.7%. You could see a much more violent move, more than 20 basis point decline both in the UK and the German 2 yields. And then when you take a look at the why, it all has to do with the oil space. Crude absolutely tumbling on the prospect of a potential end cessation to the violence, down 13.9% on Brent, down 16.5% on New York crude. We have an incredible show. John and AMH both out. With us, though, coming up this hour, do not miss this, Julian Emanuel of Evercore ISI, with global markets absolutely surging. Amrita Sen of Energy Aspects as oil plunges the most since the 2020 pandemic, and Lindsey Piegza of Stifel on the risk of stagflation. We begin with the top story, the U.S. and Iran reaching a deal for a 2-week ceasefire. Our team coverage starts right now with Bloomberg's Tyler Kendall in Washington and Jumana Bersachi in Dubai. Tyler, I want to start with you. What do we know about what concessions the U.S. made heading into this to reach this ceasefire?
Hey, Lisa, good morning. Well, this definitely marks a pulling back from President Trump's threat of what was heightened rhetoric yesterday ahead of his 8 p.m. Eastern deadline. We're still waiting on further details, trying to glean them on exactly what is going to go into this proposal. But President Trump himself said that he was willing to work with Iran's 10 top demands as a basis for negotiation. But we know that a lot of those terms, including pledges that the U.S. and Israel would not attack Iran going further and that Iran could have sovereignty over the Strait of Hormuz, are unlikely to be tenable for the U.S. and Israel going forward. President Trump himself said in a post that, quote, almost all points of contentions had been agreed to, but there are still big questions here on what some of the top U.S. demands, including limits on Iran's nuclear program, as well as what's going to happen to the country's enriched uranium stockpile, are ultimately going to look like. So while tensions are now simmered for at least now, there are still big questions here on how this is ultimately going to unfold because, of course, Lisa, it all comes down to the Strait of Hormuz. President Trump did suggest that the U.S. would somehow be involved in securing that waterway. But again, we're going to have to see how it comes to fruition.
And Jumana, on the Iranian side, we got a statement saying that for a period of 2 weeks, safe passage through the Strait of Hormuz will be possible via coordination with Iran's armed forces and with due consideration of technical limitations. Do we have a sense of what that means?
Well, it's exactly to Tyler's point. They are once again reasserting their right of sovereignty over the Strait of Hormuz, a condition, of course, that did not exist before the war. This is a new political point of leverage that has emerged as an outcome of the war. And it is something that Iran are holding on very close to as we get into the series of what is expected to be in-person negotiations by the end of this week. So this is one of their main points of leverage. And overnight, the National Supreme Council of Iran released their 10 points for what they would like to see in order to turn this ceasefire into a more lasting peace resolution. And one of the points is, again, maintaining that sovereignty over the Strait of Hormuz. They have said that for the next 2 weeks, ships will be able to pass so long as they work in coordination, this is a quote, with Iran armed forces. And therefore, once again, sort of just reiterating the control that they have over that chokehold. But it's not just that. To Tyler's point, there are other very maximalist demands that they're putting forward, including assurances that the U.S. will never attack again. They want a full lifting of sanctions. They want to be able to still work with their proxies in the region. And many of these, again, would be non-starters from the U.S.'s standpoint. So they're still very far apart. The other thing that I want to mention as well is, of course, we step back from the brink and the world today looks very different than it did, say, 24 hours ago. But I will just say that there's a question about whether all arms of IRGC are actually implementing the ceasefire, because just in the last couple of hours, we're hearing of more projectiles being intercepted in Kuwait. About half an hour ago, the UAE put up a notice saying that they're still, once again, intercepting and incoming projectiles coming through. And so it may be a couple of days before the ceasefire gets fully implemented. And so for the time being, there is a bit of relief, but a lot of cautiousness about how this is all going to play out.
Bloomberg's Tyler Kendall, Jumana Bercecci, thank you both so much for that, and we'll be catching up with you throughout the day. Julian Emanuel of Evercore ISI joining us here in the studio. Julian, before we get into it, what's your response to the ceasefire and how much you can really buy into it?
Well, so I think we just have to step back and say two things here. Number one, there's a huge sigh of relief that the incendiary language and the inflamed rhetoric of the last 3 days on all sides is being set aside for hopefully at least 2 weeks, perhaps longer. But then when you think about where the markets were and are, taken individually, the degree of hedging in stocks, credit, bonds, all bearish, and oil, all bullish, were at extremes going back to the pandemic. Taken collectively, the amount of hedging, and I've been doing this for a while, I was a junior trader on the floor during the first Gulf War. There is no precedent for the collective amount of hedging. So from that perspective, this is a sigh of relief that we do think has some staying power. But again, as we've been saying, the devil will be in the details over the next several weeks.
So if it has staying power, that means it's something that is tradable and that you do see upside here in a number of different markets. How much is it concentrated in the United States versus, say, Europe versus, say, Southeast Asia?
Well, again, if you go back to the oil price, which is essentially the linchpin for everything here, the sigh of relief being breathed in Europe this morning is proportionally larger because the effect on elevated oil prices on Europe is also proportionally larger. But when you think about it, our view has been that the bull market that started in October of 2022 has further to go. We thought that a week and a half ago as you were plumbing back towards 6,300. And frankly, what we find in bull market history is the stocks, themes, and geographies that led, and U.S. tech has been all of those, end up leading. So from our point of view, the biggest thing is the fall in yields here, telling you that is an endorsement of higher multiple equities.
Yeah, and that's clearly what is gaining the most this morning. You could see this rush into big tech, seeing valuations as more attractive after the sell-off. I wonder more broadly, though, about the drop in yields, because you aren't seeing necessarily yields going all the way back to where they were on February 27th, and you're not seeing oil prices go all the way back to where they were on February 27th. And even if this deal is enacted in some form and a prolonged ceasefire takes hold, unclear how much oil prices go back to where they were. Does there have to be a higher inflationary understanding going forward that will affect those bond yields?
No, and look, to be clear, our house view is that the landing zone for oil is certainly going to be much higher than it was. This is a structural change that will take years to work through the system. So we're looking at a Brent price that ultimately lands in the mid to high 80s, WTI, the low to mid 80s. And for stocks, both of those are perfectly fine, given the fact that over the course of years and decades, the reliance on oil for equity markets it has diminished. Obviously, it's still quite significant, as we've seen by the threat. But again, here for us, it is not, if you continue subsiding from here, is not at all a material headwind for either growth or the equity markets.
How much of a linchpin will potentially earnings be, even more so now, given the fact that that has been the one aspect of the market that has upheld all optimism, starting off with Delta later this hour?
So if in the middle of February, before the conflict began, I told you that earnings would be revised higher between here and then, you'd have called me a fool. Earnings have been revised higher. And actually, we are below consensus, projecting an earnings growth rate of over 11% for 2006. And the history of double-digit earnings growth is incredibly powerful. Since 1996, 11 years of double-digit earnings growth, the market has been up 10 out of 11 years.
Well, this is a reason why a lot of people have stayed optimistic, albeit maybe hedged. Julian Emanuel is going to be sticking with us for the hour, which is a wonderful thing. If you are just joining, there was a ceasefire agreed upon with Iran, saying that there can be ships going through the Strait of Hormuz with coordination with their armed forces and with the understanding of technical limitations. We will have more for you. And at 8 a.m. Eastern, we do have a press conference with Pete Hegseth, the Department of War, the Defense Department Secretary. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand.
Hi, Lisa. As you were just saying, President Donald Trump announcing a 2-week ceasefire last night, subject to Tehran reopening the Strait of Hormuz. The president is calling Iran's 10-point plan workable for negotiations and says the U.S. will assist in allowing safe passage through the Strait of Hormuz. Plus, the White House is also saying Israel has also agreed to the ceasefire. Israeli Prime Minister Benjamin Netanyahu saying the temporary deal, however, does not extend to Israel's war with Hezbollah in Lebanon. And a new front in the war with Iran, U.S. intelligence agencies warning private sector companies of Iran-linked cyber attacks on critical infrastructure, including drinking water systems. The warning came before the ceasefire was announced. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, an 11th hour deal.
All I can tell you is they're begging to make a deal.
If there is no deal, we are going to hit each and every one of their electric generating plants. We have to have a deal that's acceptable to me. And part of that deal is going to be we want free traffic of oil and everything else.
Colonel Wayne Sanders of Bloomberg Intelligence joins next as we try to get some details around the agreement that was reached. This is Bloomberg Surveillance. What a turnaround it's been after a ceasefire was agreed upon hours before the 8 p.m. deadline yesterday. What we're seeing right now in markets is an absolute cheer from risk assets, led by the small caps and by big tech, up both more than 3.4%. S&P futures up 2.6% in the bond space. A sense of relief that maybe there won't be the same kind of inflationary pressures that will keep a rate hike very much at the forefront of Fed officials' minds. You can see two-year yields down almost 6 basis points. 3.73%, a lesser rally at the long end of the yield curve ahead of $39 billion of 10-year notes being auctioned today, off at 1 p.m. Eastern, down 5 basis points right now to 4.24%. It is all being driven by the oil space. When you take a look at crude, at Brent, at WTI, absolutely nosediving, the most going back to 2020, April of that year, 13.3% decline on Brent to $94.78. That is the June contract. The New York crude for the May contract is 15.9% down, $95 even. Under surveillance this morning, an 11th hour deal.
We want to knock out every single thing they have. Now, it's possible that we'll make a deal before that.
All I can tell you is they're begging to make a deal. So let's see what happens.
If there is no deal, we are going to hit each and every one of their electric generating plants very hard. We have to have a deal that's acceptable to me.
Here's the latest. The U.S. and Iran agreeing to a 2-week ceasefire just hours before President Trump's deadline. Joining us now, Colonel Wayne Sanders, senior defense analyst at Bloomberg Intelligence. Colonel, thank you so much for being with us. What do you make of the agreement that was released just less than 2 hours before that 8 p.m. deadline?
Hey, thanks so much for having me on. I think the ceasefire deal is a great opportunity right now for both sides, right, to be able to claim some victory here. If you look at the U.S. side of the house, you can claim the military strikes were successful, that we were able to degrade missile stockpiles for Iranian capability, that nuclear enrichment capability has been degraded, if not for 10 to 20 years, as President Trump has been talking about. So I think those are a good side for the U.S. Iran can sit here and say that they were able to hold off the great United States military and that they still maintain quite a bit of military power and influence over the Straits of Hormuz on the global scale. So I think at this point in time now, if they can at least come to the agreement as to what the execution of that agreement across the Straits is probably going to be the most sensitive area right here in terms of what that toll looks like, what the escort capability would look like in the region.
Well, that is, to me, kind of the key point, right? And that's what a lot of people keep pointing to. Should Iran keep control, essentially, over the Strait of Hormuz, it makes them a superpower of sorts, for that a lot of people are saying. It gives them a lot of financial clout with respect to the tolls that they'd be collecting. And frankly, it gives them power over one of the most important waterways in the world. Is that palatable to the United States and, frankly, to the Gulf allies?
Yeah, I think for the U.S., for President Trump right now, it may be just based off of the situation he's in right now. For the Gulf states, I know that's not really what they're looking for at this point in time because of the power and influence that Iran could actually exert over this. When I see some of the comments that President Trump has talked about recently, right, it's, hey, this seems more like a NATO and an Asia problem. So him removing the U.S. from that situation says, hey, come buy toll-free oil from the United States, as you've heard him say over the last little bit. But on that geographic scale, if you're looking at geopolitically, a lot of the help for the Gulf states and how close the U.S. has gotten from them at this point in time, I think that they are still looking for the U.S. to play a role in either bringing down what that toll would look like, or that's going to be part of this ceasefire deal, part of the negotiations over the next 2 weeks.
Colonel Jumana Basachi was talking earlier this morning about how there have been reports of projectiles being shot from Iran. Unclear exactly how cohesive the IRGC is right now in agreeing to some sort of ceasefire. What do we know about that and how fragile some sort of truce really is?
Yeah, I think one of the biggest pieces there is if you go back and you look at the Iran-Israel 12-day war, there were even after a peace deal was made during the end of that conflict, there were still skirmishes that took place. It was almost like everybody wanted to get their last shots in. There also, you have to look at when you deal with Iran is also some of the proxies, whether you're looking at Hezbollah playing a part of this or it's IRGC that's not getting the message yet. There's a lot of pieces that are in that. I think the key there is going to be how much is actually being hit that would actually cause. There are going to be trigger points for the United States that they'll want to acknowledge and would potentially raise to an escalation. But if they think it's just a skirmish and something like that, they'll probably still hold back from re-engaging with Iran at the full-scale conflict they're doing now.
Colonel Sanders, what does this look like in 2 weeks? Is it going to be, a replay of brinkmanship or something different?
No, it's a great point, right? I look at it in terms of what does the 2 weeks for the United States military look like right now? And so if you're on the intelligence community side, you are going to be doing everything you can to confirm or deny battle damage assessment for what you've hit so far, as well as what is going on. So you're trying to pull in as much information as you can to make sure that is Iran holding to what they're saying? Are there troop movements anywhere going on so that you can potentially provide some type of mitigation strategy? If you are a planner, you're putting together what that would look like if an agreement is not reached in those 2 weeks so that you are prepared to jump directly back in with full-scale conflict as they did before. The maintainers are doing everything they can to maintain those aircraft, the flight lines, everything else like that. The only ones who might get a little bit of rest right now are the pilots, but they're still going to probably have overflight to make sure that we still have intelligence, surveillance, and reconnaissance during this time frame. So if it's all said and done, you're probably going to see a slow amount of withdrawal of U.S. forces. I think with the third carrier group on the way, you might actually see the Ford head back while the Bush gets there from a carrier strike group perspective. But you're probably still going to see quite a bit of presence in that region, even if nothing is taking place, just to maintain situational awareness in the area, just in case.
Colonel, do you have a sense of how the alliances look right now? Who's lining up with who in terms of trying to pressure some sort of ongoing ceasefire that can last?
Yeah, I mean, I see Pakistan, Egypt, and Turkey pushing really hard right now to maintain that ceasefire. I know that when you look at UAE and Saudi Arabia, they were wanting us to continue to push. They were pushing for the United States to continue to push Iran further back militarily. From that perspective, you see a lot of that coming based off of the amount of Iranian strikes. We're mainly focused on UAE and Saudi Arabia, disproportionate compared to anywhere else. And a lot of that, I think, is due to some of the trade deals that we have with the United States, that those Gulf states did, as well as the military presence and the allowed access that the military has had in both Saudi Arabia and in UAE.
Colonel Wayne Sanders of Bloomberg Intelligence, thank you so much for being with us and all of your insights. Julian, Emanuel, I'm looking at this and thinking how much has changed, right? How different is the landscape that we're looking at, even if a ceasefire were to last? Is there anything fundamentally, other than oil prices being a bit higher than where they were to begin, that has materially shifted for you in terms of your base assumptions going forward?
Well, you've certainly degraded a great deal of Iran's capabilities, regardless of their ability to control the straits, either in the near or the medium term. And so from that perspective, one can argue that there is a change, which frankly, puts a cap on oil prices, but also because of the greater instability in general, also puts a much higher floor on oil prices. But I think the Colonel made a pretty good point here, is that there are so many moving pieces, and as you pointed out, so many shifting alliances, that it's very difficult to fathom how the next 2 weeks, let alone the next 2 months, unfold.
One market move that caught our attention this morning was the Chinese yuan, the renminbi. We're looking at right now the dollar at the weakest level versus the renminbi going back to 2023. It has completely taken out some of what we had seen at the February 27th deadline. You've seen the yuan strengthen significantly beyond that. And this comes at a time where people are talking about the petro-yuan, right? We had the petrodollar after 1974 and the Henry Kissinger Accord with Saudi Arabia. Now there is speculation that any kind of transfer of oil through the Strait of Hormuz will be transacted in the Chinese renminbi. How much does this type of speculation get your attention and make you actually think about where you're going to be investing and what the base currency is going to look like?
Well, again, from an investment point of view, we continue to be believers in the U.S. in terms of its capital markets and the risk-reward opportunities. But you have to acknowledge that, if nothing else, the decline in oil prices in the last 24 hours, because China is such a reliant importer, particularly on Middle Eastern oil, is significant and certainly a tailwind for China. And frankly, what it does is the reflection of the currency certainly gives Chairman Xi a much more robust jump-off point for the meeting that's going to happen with President Trump a month from now.
Yeah, on the flip side, there's also a question about verbal intervention and verbal diplomacy, and what we could hear later today from President Trump, what that could look like. Jordan Rochester over at Mizuho was saying that the hardest part of this war is not understanding energy logistics, but markets' reaction to White House messaging. What are you hoping to hear from the White House messaging that could potentially set this market more permanently at ease?
The concept of more permanently at ease certainly has much longer than a 2-week shelf life. Frankly, I think if we hear more of what we heard yesterday evening, that there is progress being made and there are negotiations ongoing, that's enough.
This morning, it is Whipsaw Wednesday with risk assets absolutely soaring. Coming up, we're going to be speaking with Amrita of Energy Aspects, with oil plunging more than 10%, the most going back to 2020 amid the height of the pandemic. Plus, Yahira Anand with your morning movers, airline stocks soaring following news of a ceasefire. This is Bloomberg Surveillance. seeing a huge surge in risk assets after a ceasefire was announced less than 2 hours away from that 8 p.m. deadline yesterday, led really by some of the smaller companies as well as the technology companies. 3.7% gain on the Russell 2000 futures, NASDAQ futures up 3.5% in the bond space. A real bid into credit, into fixed income, a belief that maybe inflationary pressures will not force the Federal Reserve and other central banks to hike rates lower by about 6 basis points at the front end. 2-year yield 3.73%, 10-year 4.24%. And then, of course, all of this is being driven by oil prices. Oil plunging the most going back to 2022, with Brent and WTI both down more than 10%, almost 14% on Brent, 16% on crude. We are getting the beginning of earnings season, and this to me is going to be the key moment going forward. How much can companies adjust and adapt to a very tumultuous moment? How Delta Airlines is adapting and adjusting is leaving out full year guidance in their latest statement announcing earnings. They do beat expectations pretty much across the board, whether it's passenger revenue, whether it's earnings per share, also seeing profit of around $1 billion for the second quarter. But they talked about how they are trying to insulate their balance sheet from some of the increase in oil prices. Protective acts include meaningful cuts to capacity growth. They say that demand is still strong, though. This is the key point. And Julian Emanuel, who is with us for this hour, this is what everyone keeps going back to. The momentum heading into this, very strong.
Yeah, look, the economy was in a good place, which allowed the stock market to weather this disruption. And again, whether it is the economy now looking as if it won't be on a stagflationary path and back towards 2% or more GDP growth for the year, it's a reinforcement of earnings and ultimately the entire message that things are on reasonably solid footing.
And traders are hearing that message loud and clear, with Delta up 9% in pre-market trading. With more on that and many others, we are 3 hours away from the cash open, and Yahaira Anand has your morning movers. Yahaira.
Hi, Lisa. Great segue. A clear beneficiary of this ceasefire is the airline stocks, and they are all higher across the board and now higher now that Delta came out with good earnings. The hope now is that oil starts flowing through the Strait of Hormuz, easing some of those supply concerns that had sent jet fuel costs soaring. And of course, that is critical for the airlines since fuel is such a massive part of their costs. And as we're seeing oil pulling back sharply, we are seeing pressure being put on U.S. energy stocks. These names had been big winners during the conflict. Occidental up some 16% since the war began. Exxon up 10%. So this is a clear reversal we're seeing as that risk premium comes out and investors lock in those gains. And we end on tech stocks, another clear beneficiary of this ceasefire. They had been hit hard during this conflict with oil higher, inflation fears pushing rates higher, but the pressure is easing. So you are seeing this rotation back into the more growthier parts of the market. So names like Google up 4% in the pre-market. Lisa.
Thank you so much, Yahaira. On our radar this morning, the U.S. and Iran agreeing to a 2-week ceasefire, averting a major escalation just ahead of President Trump's deadline. Iran agreeing to reopen the Strait of Hormuz. President Trump saying the U.S. will help restart traffic through the waterway. The White House also saying that Israel agreed to the ceasefire. Israeli Prime Minister Benjamin Netanyahu disputing that, saying the temporary deal does not extend to Lebanon. And more than 800 vessels remain trapped in the Persian Gulf, according to the Wall Street Journal. Iran is telling ships anchored near the Strait of Hormuz they must have permission to cross or face being destroyed. And Julian, this is really the question. If you have 800 ships that are still waiting to get through, you have many others wondering whether they should begin their journey. How important is to see traffic actually begin to flow and under what conditions?
No, we definitely want to see it. And I think traders across the world will have that app showing the traffic in real time. And you do want to see it. And when you think about all the sticking points and the complications of the next several weeks, control of the Strait is far and away the biggest point.
Yeah, and how much is it going to be concentrated with oil or just all of the potential resources, right? I mean, how much do you see this trickling out to agriculture? How much do you see this trickling out to, the petrochemical space, especially in light of some of the damage that's already been done?
So, for instance, you started the show talking about how much the Kospi has rallied. Let us remember that helium which has been bottlenecked in the Strait, is an incredibly important input into chip manufacture.
Yeah, how much does South Korea and, frankly, the entirety of the complex need that helium? The Kospi up more than 5% this morning, so we're going to keep watching that. Meanwhile, oil, very much the asset class in focus, plunging by the most since 2020. Key questions still remaining on what's next for energy flows through the Middle East. Joining us now is Javier Blas of Bloomberg Opinion. Javier, I'm so glad to have you on the show. What's your sense of what's actually been agreed upon and how much potentially, should this stick, this fundamentally changes the oil trade?
Well, so far what we have seen is two statements which in parts are contradictory. President Trump said that he wanted a safe and unrestricted flow of all commodities through the Strait of Hormuz. The Iranian statement say, however, that it's going to be limited because of technical capabilities, but also that approval is going to be needed by his military. So those statements are contradictory in nature. The fact is that at this moment, and that's emphasis at this moment, very little is moving out of the Strait of Hormuz. The oil market has priced it as if it was completely open and full. But I think that the sentiment from many oil traders is that over time, and I think that that's going to be in the next few hours, we will start to see some movement both in oil and gas flows, LNG flows from the Strait of Hormuz, and that's going to really alleviate tension. And we are still in a bad situation, but worst case scenario has completely been avoided, at least for now.
There is a feeling, though, that the backwardation in the oil curve is extreme, is at record levels. If you take a look at where spot Brent was trading just yesterday at over $140 a barrel versus the further out $70 or $80 that you see at the end of this year. Do you see that shifting, that backwardation is going to change as people reassess what the landscape looks like?
I think the backwardation is going to remain for a few more days into the market, that extreme backwardation. If a refinery is short of oil right now and it needs the barrels of oil, it's going to have to pay a big price to secure the oil. But if we start seeing some movement of oil, that some of those panic buying may recede, some of the refineries may be able to withhold a few more days with the hope that the oil is going to start flowing. So I think that the key question is the next 24 to 48 hours. If we see a meaningful movement of oil out of the Strait of Hormuz, that will be significant. Will oil tankers move into the Strait of Hormuz? That is a much bigger question because that really takes quite a lot of risk. Can you get a ship into the Strait of Hormuz, take the risk that maybe that ship gets trapped if the peace talks fail? Because to restart production in the Middle East, we need first the vessels to get out, but we also need new vessels to go in. And that second phase, I think, is going to take more than a few hours, and it probably will take a few days.
Javier Blas of Bloomberg Opinion, honored to have you on the show. Love to read your commentary, and hopefully we can catch up with you again soon. Amrita of Energy Aspects writing, even after Hormuz flows restart, most producers will need several months to restore production. Amrita Sen joins us now. Amrita, I would love to get your sense of just how much has changed given the truce that was announced last night.
I think I completely agree with what Javier said. If you read the statements, they're actually two quite different statements. We are hearing from refiners and lifters who are trying to kind of get a ship in. Firstly, the cost is prohibitive. You know, you're talking about more than $40 a barrel. Even if you can get insurance, there's a huge amount of confusion with regards to whether they need to pay the Iranians, how they're going to pay the Iranians, because payment to be made to the Iranians is not easy given the sanctions. The Iranians are actually sending out messages to vessels outside the Strait saying that, you know, if you are actually going to pass the Strait or if you're going to come in, you need our permission. So this is by no means a Strait that's open for business, to be very clear. What I would say is that we are likely to see the ships that are within the Strait right now, whether they're empty or whether they're loaded with crude and products. We've counted, our cargo tracking team counts about 250 vessels. Those over time could potentially move out with Iran's permission, but I don't think you'll see vessels moving in. And I think that's going to be the critical thing, unless you actually have a complete ceasefire, not just a 2-week one, but we know that hostilities have ended.
Amrita, when thinking about the growth versus inflation trade-off, I'm just wondering, have you seen any evidence of demand destruction in these last several weeks?
Great question, because, and you guys were just talking about the divergence between actual kind of physical prices and futures prices. The problem is everything is being reflected in the physical price, right? Dated Brent was trading above $140. Dubai traded back in a few weeks ago at $160 per barrel. And that's actually being reflected in products prices. If you look at diesel, if you look at jet fuel, they've been trading over $200 per barrel, even in the US. And yes, we have seen some demand destruction in parts of Asia, partly also because governments have stepped in and asked for rationing in advance, or as kind of the crisis has progressed. So we have definitely seen about 1 million barrels per day of reduction, mostly in jet fuel, also, given the flight cancellations in the Middle East, but also in like naphtha, LPG, so steam crackers, things or units that would actually make plastics effectively, right? So again, the challenge we have in this is that because this is hitting Asia first, it's a really long time lag before it hits the West, right? Whether it's the products itself, jet fuel, gasoline, diesel, or the end products, it's the clothes we're wearing or all the kind of plastic goods that we consume. And that's why there's so much complacency in the market. But yes, we have seen the demand destruction, and I don't think it's over yet.
Amrita, how long is that lag time before maybe you're going to see ongoing higher oil prices and higher product prices, even if the ceasefire were to hold today?
Yeah, look, the damage in some ways has been done, right? We were all kind of talking about this big surplus in oil markets. Our surplus was definitely not as big as some of the U.S. investment banks out there, but still it was a big surplus. That's been wiped out now. All that Russian oil that was on water floating around, that's now gone. India's taken all of that. So for the oil market, we're pretty much starting from scratch, right? So we are going to be trading in a higher range. But more importantly to your question, that when do we see that impact? It's about a 2.5-month lag, because Asia would be buying the crude in March, that arrives in April, they process they make the products, and then they send it west. So the earliest the West is going to feel the real pinch is May, really into June. So we haven't seen the actual shortages being felt yet.
Amrita Sen of Energy Aspects, thank you so much for your insights. Interesting also that Delta saw second quarter fuel costs increasing more than $2 billion at the high end, highlighting how airlines are already pricing this in and adjusting capacity and prices as a result.
But amazing, look at that report. They beat on earnings. It's just a tribute to corporate America, whether you're an airline, a manufacturer, or a technology company's ability to generate margin and under all sorts of circumstances.
And earnings season kicks off in earnest next week. Right now, let's get you an update on stories elsewhere this morning. Here's a Bloomberg Brief with Yahira on Yahira.
Hi, Lisa. President Donald Trump announcing a 2-week ceasefire last night. The deal is subject to Tehran reopening the Strait of Hormuz. The president is calling Iran's 10-point plan workable for negotiations and saying the U.S. will assist in allowing safe passage through the strait. The IMF is poised to cut its forecast for global growth as a result of the war in Iran. Managing Director Kristalina Georgieva says the conflict has triggered a negative supply shock. The new figures will be released at the IMF meeting in Washington next week. And Delta shares surging even more after earnings, up 12% in the pre-market. The airline reporting better than expected quarterly results. Meanwhile, due to the war, Delta now expecting to incur more than $2 billion in higher fuel costs through June. The carrier is sticking to its previous full-year profit forecast due to uncertainty. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, all eyes on energy.
So right now, my view on inflation is we're looking at an inflation rate for the year as a whole of something like 2.75%. But of course, it depends what happens with energy prices.
Lindsey Piegza of Stifel joins next as we talk about the potential bleed through to consumer prices. This is Bloomberg Surveillance. Good morning. Welcome back as we assess a new landscape following the ceasefire agreement that was announced last night ahead of the 8 p.m. deadline. We're looking at stocks absolutely ripping, led by tech and small caps. Those shares both up about more than 3.5% in pre-market trading. S&P futures up 2.7%. It is all being driven by oil prices. Oil plunging after people seeing a reprieve to potentially some of the pressures. You're seeing a 14.3% decline in Brent, a 16.4% on the near-term contract of crude. And we're continuing to get commentary from a number of different companies. We got Delta earnings. They beat across the line. However, they did not necessarily increase their full-year forecast and talked about a $2 billion hit to some of the increase in oil costs for the second quarter. Now Exxon coming out saying that they see a 6% hit to first quarter production versus the fourth quarter on the Mideast conflict. A real question here about the actual physical damage that has already been incurred by a number of different oil companies, both in the region and outside of the region that have assets there, given this has been going on for quite a while, Julian.
Yeah, look, and this just shows you that, for the most part, the oil companies trade more bullishly as the spot oil price rises. But at the end of the day, the operational difficulties that a company like that has, in some respects, are even more extreme than a company in another industry. And as a CEO, you've got to deal with this in various different ways.
But it also shows that the physical constraints are there. And potentially it's going to take time before this all gets worked through, both when it comes to the damage being done to oil facilities, as well as just the backlog, as Amrita was talking about.
I think you measure the repair in terms of months or maybe even years, not days.
Which is a reason why people are trying to game out exactly what kind of inflationary read-through there is, especially if there isn't necessarily the same hit to growth. Under surveillance this morning, all eyes on energy.
I expect headline inflation to actually be elevated, in the middle of this year. Right now, my view on inflation is we're looking at an inflation rate for the year as a whole of something like 2.75%. But of course, it depends what happens with energy prices. I think this monetary policy is exactly where it needs to be, and then we can respond if the situation changes.
Here's the latest. Plunging oil prices adding to bets the Fed could still cut rates later this year. Pressures from the energy shock remaining despite crude falling below triple digits. Lindsey Piegza of Stifel writing the domestic economy is not strong enough to perpetually withstand elevated energy prices. Lindsey joins us now. Lindsey, what a 24 hours. What do you make now of the inflationary pressures? Should the ceasefire potentially hold?
Well, that's the big question. There's still a number of unknowns when we're talking about the impact of higher energy prices, whether or not the ceasefire does hold, whether or not we see the Strait of Hormuz reopen in its entirety. But what we know is that the faster the oil markets are able to normalize, this will mitigate the prolonged impact of elevated energy prices, filtering out into not just the domestic economy, but of course the global economy. But it all hinges on whether or not we see energy markets return to a more normal functionality.
There is a feeling, Lindsey, that there still is going to be an inflationary read-through, especially because there's a lag time before some of the products from around the world make their way to consumers. Diesel prices still incredibly elevated relative to where they were, say, 6 months ago. At what point are we looking at either a permanently higher inflation rate that the Fed just accepts, or potentially a Fed that is not willing to ease rates, even in the face of some evolving slack in the labor market?
Well, the conditions were already going to prove very difficult for the Fed to talk about any additional accommodation unless we saw a material deterioration in labor market conditions or a market deceleration in inflation. Now you layer on the risk of this global, potentially prolonged global energy price shock, and this simply reaffirms the position of the Fed on the sideline for a prolonged period of time. Now, as you mentioned, there is a sizable lag in terms of oil filtering through to not just gas prices, but the broader economy. So we will continue to see upward pressure in inflation in the coming months, again, which will reiterate the Fed's need to remain on the sideline. But the Fed is very unlikely to react to higher energy prices if there's any whiff of a temporary or transitory nature of these pressures. Remember, this is a committee that has been tolerant of above trend, above target inflation for years. And so this time around will be very similar to that, to the Fed not necessarily even opening the door to a serious conversation about reversing course, but again, simply solidifying the Fed on the sidelines, sitting on its hands until we hopefully do see some reprieve from a more normalized energy market.
So when you look at the next 12 months, Lindsey, which is the bigger risk right now based on the oil price spike, growth or inflation?
Oh, right now it's inflation. Because remember, the domestic economy is starting from a position of relative strength. We did have a relatively solid growth profile, a relatively resilient consumer, still positive investment flows, gains in productivity as a result of this massive expansion and adoption of technology. So the U.S. economy was relatively well positioned to withstand at least a temporary shock, but the starting point from inflation was already elevated. We were already materially above the Fed's 2% target, as we have been for years. And so not only does this speak to the notion that the Fed stopped short of a sufficiently restrictive level of policy the first time around, but it does leave the Fed in a position to increasingly focus on elevated prices, that side of the dual mandate, as we do continue to enter this unknown period of higher inflation.
Just quickly, Lindsey, how important is CPI for you and, frankly, for the Fed coming out on Friday?
It's unusual that the CPI report will take precedence over the PCE, the Fed's preferred measure of inflation, but that is the February report. The CPI on Friday will give us the first look at how these higher energy prices are seeping out into the broader economy via transportation, via food, via the manufacturing component. And so this will be a significant read. If we do see that headline jump over 1% on a monthly basis, ticking higher to a 3.5, 3.7%, this is going to be a significant wake-up call for the Fed. And again, reiterate the fact that the Fed will be on the sideline for a prolonged period of time.
Lindsey Piegza of Stifel, thank you so much for that. Julian, Emanuel, it seems like people came into the year saying the Fed was going to cut rates by a couple of times. Now people are looking at this and saying, given the fact the U.S. can weather all of this and talking about how strong those earnings are, could we be at neutral right now?
Potentially. That's not our base case. We still think there will be one, perhaps two rate cuts to the end of the year. The one thing we do know, and we have thought all along, is that the concept of the Fed hiking in 2026 was, is, and will be preposterous.
Taking a step back, what does it do to markets, the deepest, most liquid markets, and people's confidence in them, if everything can change on a dime? We were talking about how reminiscent this moment is to what we saw last year at almost the exact same time with Liberation Day and then some sort of pivot point. How much does that undermine confidence?
Well, and again, this is a unique time we're living in. Multiples are elevated because liquidity, by and large, has been very high, and technology, the promise of AI is there. Productivity has been increasing, but along with that, because so much is dependent on policy in the short term, volatility is higher. We have to learn to live with it.
Julian, Emanuel, thank you so much for spending the morning with us. Always wonderful to have you on the show as we look at markets that are absolutely ripping after a ceasefire was announced heading into the 8 p.m. deadline last night, led by small caps, led by the Kospi, led by European equities seeing one of their best days going back to 2022 with oil prices plunging the most since the height of the 2020 pandemic. Coming up next, Altmann of Barclays, Seth Jones of CSIS, Scott Modell of Rapidan Energy, and Earl Davis of BMO. You're watching Bloomberg Surveillance. Good morning.
This is a big hit to consumers and households and businesses.
We're seeing the risks manifest themselves on both sides.
Inflation is fundamental for a more optimistic macroeconomic outlook.
The risk is that inflation expectations begin to unwind.
We do not see March
core inflation being all that much higher than it was in February.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning, live from New York. Welcome to the second hour of Bloomberg Surveillance. A 2-week ceasefire propping up risk assets around the world with many questions remaining. Sending oil prices tumbling the most since the pandemic. Iran saying traffic can go through the Strait of Hormuz with some key caveats. Analysts searching for the details of the agreement to understand how quickly shipping can resume. Right now, markets are not waiting for anything. There is a complete rally rip-roaring across the world, which you see in the U.S. You see futures inflecting upward, led by the small caps, led by the big tech names. 3.4% gain on NASDAQ futures, 3.6% gain on the Russell 2000. When you take a look at the rest of the world, it's an even bigger rally, especially in some of the areas that have been most volatile. The Kospi now up almost 7% on the day after being beaten up in the wake of fears around Southeast Asia and Asia more particularly tied to oil prices. The Nikkei up more than 5%. The DAX up almost 5% for one of the biggest days that we've seen going back to 2022. In the bond space, a real bid in. Possibly inflation will not put a rate hike back on the table. And across the board, particularly the front end around the world, you are seeing yields tumble. 3.73% down 5 basis points on the 2-year. Over in the UK and over in Germany, yields down more than 20 basis points at the front end. And all of this tied to oil prices. When you take a look at crude, WTI at Brent tumbling more than 10%, down 13.9% for Brent, down 13% for WTI, after expecting maybe a reprieve to some of the violence as well as some of the blockages for a lot of the oil tankers. We have an incredible hour coming up. Alex Altmann of Barclays is going to be joining us for the full hour, which is a wonderful thing. With that relief rally sweeping through global markets, he's feeling incredibly vindicated. Seth Jones of CSIS with Iran delivering a 10-point plan to end the war. And Rapidan Energy Group CEO Scott Modell as crude prices drop back below $100 a barrel. We begin this hour with our top stories. Stocks surging following the announcement of a 2-week ceasefire between the U.S. and Iran. Bloomberg's Jumana Boutersecchi joins us now from Dubai. Jumana, what do we know about this agreement and how quickly traffic can get back going through the Strait?
Yeah, well, it's a bit of a turnaround in sentiment from where we were about 24 hours ago, Lisa. And yesterday we were reporting that there were perhaps little chances of a diplomatic breakthrough. But indeed, in the early hours of this morning, exactly 90 minutes before his deadline, President Trump announced that they had agreed to a 2-week ceasefire that was shortly followed up by a post by the Iranian foreign minister as well, saying that they too had agreed to a temporary ceasefire. But, and this is key, the opening of the Strait would be conditional on vessels getting approval from the Iranian armed forces. So again, a key stipulation here, Iran once again reasserting their right to control over that key waterway, which is a non-starter for many countries and especially Gulf Arab nations. And many ministries of foreign affairs this morning, including the likes of Qatar, Saudi Arabia, have put out comments saying that they endorsed the ceasefire, but would like to see a full reopening of the Strait similar to how it was before the war even started. So this is the premise for the ceasefire. It is very tenuous, and even just in the last couple of hours, we've reported on incoming missiles being intercepted over here in the UAE, drones being intercepted in Kuwait as well. The Iranian state media saying that around 10 a.m. local time, their refinery got targeted too. So again, some question marks about whether all sides are holding up their side of the deal here. There will be in-person discussions later this week that has been confirmed by Islamabad, is expected to take place on Friday. Unclear who exactly is going to be attending from the Iranian side. But to go back to what you were saying, we find ourselves in a situation now where, in addition to all of the other military objectives that the U.S. had set out to achieve from this war, we've got an additional problem now, which is the Straits, exactly who is controlling the Straits. And for the foreseeable future, Iran wants to retain that control. There are reports that they would like to process a fee for ships that are passing through, clearly a non-starter as well. So that is the starting point for those negotiations that are going to take place towards the end of the week. Whether the two sides can actually come together for a more sustainable cessation of hostilities is a big question that's still hanging over the region. But for now, relief that we've avoided the worst case scenario.
Giovanna Bercecci, thank you so much, as always, for that. Joining us now, I am so pleased to say, is Global Head of Equities Tactical Strategies at Barclays, Alex Altmann, here in the studio. Alex, wonderful to see you. Thank you for being here.
Thank you.
So you wrote a quote that I want to read in your recent research. It has been said that knowledge is to know that a tomato is a fruit, but wisdom is to know that a tomato does not go in a fruit salad. How does that relate to the moment that we're in?
It's actually a quote from a journalist in the 1950s in the UK, so I wish I could say it was mine, but I'm now adopting it as mine. Why does it relate to today? It relates to today because over the past month we've had a huge amount of knowledge thrown at the market for an event which I would say people weren't necessarily experts on. And even if they were experts on Middle East geopolitics, they weren't necessarily an expert on Donald Trump. And so you had this sort of X factor when trying to navigate that. And the point being is that for all of that knowledge, did they necessarily have the wisdom to understand how this negotiation process was actually unfolding behind the scenes because of the brouhaha coming from both the administration and also from the Iranian side? And I think that actually demonstration by what's happening in backdoors from Pakistan, China is a clear illustration that actually a lot of people had a lot of knowledge, but I'm not sure they necessarily had that much wisdom.
So you've been buying. You were bullish and constructive on equities ahead of this, believing that there would be some sort of resolution, that things wouldn't get to the most extreme levels, and that, frankly, oil prices would eventually go down. How do you feel today, looking at how much assets have rallied, looking at how much oil prices have come down, and deciding whether it's worth it now or whether kind of all of that has been given up in terms of a premium?
So let's look at risk assets first, right? Which is, this has been going on for a month. I mean, really, we started talking about Iran right at the end of January. That's when it sort of all kicked off. And then obviously the war actually commenced at the end of February. So because this has been going on for a while, it's very hard to believe that we're going to unwind the risk reduction process that's been going on for a month in the span of a day. So we look at a lot of positioning metrics. All of them are kind of pointing to the same thing, which is hedge fund discretionary net exposures dropped dramatically. Vol control and CTA exposures across major US indices and global indices reduced, not only just to reduce length, but got short. And we know for a fact that sentiment got pretty bombed out. I mean, there was a lot of doomers and panickers and individuals on social media that were and still doubling down today, saying the ceasefire won't hold. So the point being, from a risk asset perspective, is that our perspective is this can really overshoot to the upside. And remember also, earnings revisions have been positive. This is something that Vinu's team in research have been basically talking about, and credit to them. You know, they upgraded their S&P forecast in Barclays research all the way through this because the earnings revisions have been positive. So right now, the S&P is still only trading on a lower multiple today than it was in May of last year in the wake of the resolution around Liberation Day. And so the room for us to move further to the top side, even with a precarious ceasefire, I think is still quite...
There are a lot of moving pieces here, and I would love to dive in. So on one hand, you're talking about earnings. A lot of that is concentrated in the United States in particular. We just got Delta, a robust backdrop, beating on earnings, even with the potential overhang of higher oil prices. We do see this pretty much across the board, and earnings will kick off in earnest next week. What about, say, in Asia, where you're seeing that pullback, that you saw that huge pullback in Southeast Asia, and now that rip over in South Korea? What about in Germany, in Europe, which has been completely avoided by so many people during the entirety of this conflict?
Yes, so look, I think that there's a natural reflexive appetite to go back into global equities. Remember, that was the story for all of January and most of February as well. I think the challenge is today, and kind of tying into your question about where oil prices go, we're probably going to expect a slower normalization of oil prices. Just naturally, there's going to be frictions in the Straits of Hormuz. And also, let's not forget, one of the reasons why we've been so bullish on commodities, energy included, is because it's kind of every man for himself now. We need strategic reserves of not just energy, but also for all commodities now. So if that applies to creating more demand and more strategic reserve rebuilding, and there's a higher price tag for oil and energy products, then for net energy import regions, which is, of course, Asia, which is, of course, Europe, then it's going to be more of a challenge in terms of the earnings trajectory for those regions.
Meanwhile, we saw this morning, Exxon says that it's seeing 6% of its worldwide output shut as a result of the Mideast conflict. There will be the rebuilds that will be required on the heels of this. Does that make you even more bullish on some of the energy-related assets in equity markets, particularly in areas like the United States, or say even in the Middle East?
I think we've got to work off the starting point, which is energy has been the best performing sector year to date by a dramatic margin, as you would expect. And so there's been some momentum chasing in there. It's basically been one of the only portfolio hedges that actually that has worked over the past few months. We should expect some near-term give back. But that's going to rotate back into other part of the commodity complex that uses energy as an input cost for producing aluminium, for producing copper, and so on and so forth. So I would expect those base metals and the like to actually be the real commodity driver as a reflexive move back up at the expense of energy. But I think ultimately the trajectory for all of the commodity complex is actually going to be higher thematically.
Has anything changed from February 27th to today? Even if, say, the ceasefire does hold, can we go back to where we were on February 27th when it comes to both oil prices and when it comes to also this expectation of where risk could come from, given headline volatility that has been extreme?
I think we have to acknowledge something has changed, right? And one of the things is there's going to be a lingering perception of the reduction in U.S. hegemony, right? And so the fragmenting of the global world order, is that really necessarily new? It's something that's maybe it's been going on for a little bit of a while. So that there is that. From a markets-related perspective, we've got to probably accept that the price deck of oil is higher than it was at least near term. And the normalization process just mechanically would take a while. We lost some production because of attacks. The Straits of Hormuz are not fully open. We don't have full shipments going through there. But we do have countermeasures, of course. We have the East-West pipeline. We've got the Fujairah pipeline. We've got things that can at least mitigate us near term. So I think ultimately we don't know, and I think other commentators have said this, we don't know the full effect of the earnings hit. So we have to acknowledge that. Probably in a reduction. I don't think we're going to go back to 22 times S&P forward earnings. But for example, we could comfortably go back to, say, 20.5, 21 times, still putting in a discount, and that's still going to get us back to all-time highs.
Alex Altmann, you're going to be sticking with us for the entire hour, which is a wonderful thing. Right now, let's head over and get an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. President Donald Trump announcing a 2-week ceasefire subject to Tehran reopening the Strait of Hormuz. The president is calling Iran's 10-point plan workable for negotiations and says the U.S. will assist in allowing safe passage through the Strait of Hormuz. Ecuador's President Daniel Noboa says he would welcome U.S. troops to help confront the security crisis in his nation. Speaking to our own Annmarie Hordern, Noboa said, quote, its international collaboration against crime and a U.S. troop deployment could happen as early as this year. And Intel announcing it's joining Elon Musk's effort to develop semiconductors for Tesla, SpaceX, and xAI. Intel will help the so-called Terafab project refactor the technology in a chip factory, which typically helps make semiconductors more powerful or reliable. That's your Bloomberg Brief, Lisa.
Thank you so much, Yahira. Up next, a last-ditch deal.
All I can tell you is they're begging to make a deal.
If there is no deal, we are going to hit each and every one of their electric generating plants. We have to have a deal that's acceptable to me. And part of that deal is going to be we want free traffic of oil.
Seth Jones of CSIS joining next. This is Bloomberg Surveillance. Good morning. Seeing a rip-roaring rally in risk assets this morning after yesterday's ceasefire announcement, led by equities most notably in Asia and Europe. Here in the U.S., S&P futures a little bit less excited, 2.7% gain, still a remarkable bounce after some of the pessimism in markets. Two-year yields over in Germany, over in the U.K., absolutely tumbling down 23 basis points in Germany with 2.49%, an expectation that maybe central banks will not have to hike rates. And that is particularly relevant in the European region. Two-year yields in the U.S. down 6 basis points, and crude tumbling 14% decline on Brent to $93.98. Right now, we want to head over to this idea of what has actually transpired, given the fact that we have gotten this ceasefire under surveillance this morning, a last-ditch deal.
We want to knock out every single thing they have. Now, it's possible that we'll make a deal before that.
All I can tell you is they're begging to make a deal. So let's see what happens.
If there is no deal, we are going to hit each and every one of their electric generating plants very hard. We have to have a deal that's acceptable to me.
Here's the latest. The U.S. and Iran agreeing to a 2-week ceasefire, with Tehran vowing to reopen the Strait of Hormuz. Bloomberg's Tyler Kendall joins us now. Tyler, we're expecting a press conference at 8 a.m. Eastern in about an hour or 45 minutes time. What kind of positioning will the administration say in terms of how this deal was reached and what's ahead?
Hey, Lisa, good morning. Well, we're really expecting the administration to tout tactical successes of the military operation so far, considering that there are still some big lingering questions about what exactly is going to transpire when we see, if and when we see, a longer-term agreement. Because President Trump is pulling back his threats, at least for now. But we heard from the Vice President, J.D. Vance, earlier today, who's set to lead the new round of negotiations, calling this truce, quote, fragile. Still, the VP does maintain that the U.S. has obtained its full military objectives amid questions about whether or not some of those top U.S. demands, including limits on Iran's ballistic and nuclear missile programs, will be included in a longer-term deal. Because, of course, all of this is contingent on the reopening of the Strait of Hormuz. But as Iran continues to signal intent to influence the waterway, that really could complicate the bid for a longer-term agreement. Because President Trump has said himself that he has agreed to negotiate on the basis of Iran's top 10 demands. But it's our understanding that many of those demands are unlikely terms for the U.S. and Israel to agree to, including assurances that there would be no more attacks on Iran and that Iran could have sovereignty over the Strait. Now, President Trump himself says that the U.S. will help ensure traffic through the waterway. He said in a post that the U.S. would be, quote, hanging around amid a more than 800 ship backlog. But we really know that President Trump wants to see allies help when it comes to the waterway. We did hear from the French President Macron earlier today, who previewed we could expect about a 15-country coalition to deploy what he is calling a strictly defensive mission in coordination with Iran when it comes to the Strait of Hormuz. Lisa, I will quickly point out that NATO Secretary General Mark Rutte will be at the White House today. I would expect to hear a lot of rhetoric out of the White House about putting some more pressure on our allies as the ceasefire takes hold.
Bloomberg's Tyler Kendall, thank you so much for the update. Joining us now is someone who's worked in the Defense Department, who's worked with military forces in the U.S., has extensive experience in this entire region. Seth Jones of CSIS. Seth, thank you so much for being with us. I want to start with your response to the ceasefire, how realistic you see it holding for after that 2-week and even the entire 2-week period.
Well, look, I think it's helpful that there have been negotiations between the U.S. and the Iranians. I think it's helpful that, and a step forward, that we are at a ceasefire. I just think even in talking to Israeli officials recently, I think they do not expect the Iranians or Iranian partner forces to abide by any deal over the medium to long term. There were already sirens going off in Tel Aviv last night for potential incoming Iranian rockets. So I do have low expectations that this is going to stick over the next 2 weeks.
So what do you think has actually been accomplished, Seth?
Well, it's hard to say. I mean, when I look at the 10-point plan that the Iranians have put together, most of those, or at least many of the points, are completely unacceptable for the U.S. over the long run. They are the withdrawal of all U.S. forces, particularly combat forces from the region, Iranian control of the Strait, and a number of other things, allowing Iran to have missiles and drone programs, and then compensation for the damage that Iran has incurred over the past several weeks of the conflict. I mean, I don't think there's no realistic expectation that the U.S. is going to provide compensation, probably or Gulf states along those lines. I think there's a lot to hammer out.
Seth, on that point in terms of a lot to hammer out, realistically, what do you think could be achieved from that 10-point plan? What do you think are the lowest hurdles to beat here?
Well, I think the lowest hurdles would be some kind of a joint arrangement involving countries in the region, particularly ones that are on the Strait of Hormuz, that share any tolls that are charged to commercial ships going through the region, and potentially also some security of commercial vessels that go through the region. So it's not all on the U.S.'s shoulders, but it'll hinge on really how much trust any of these countries, including the U.S., have that the Iranians won't fire on commercial vessels, and I think we'll have to see.
And then you obviously talk about this toll booth not being a realistic prospect. Could you talk a little bit about what's on the sanction relief side, or also the offshore frozen funds as well, which could maybe provide some compensation in lieu of that toll booth instead?
Yeah, I mean, it's possible that there could be some sanctions relief for Iran. I mean, the challenge is that both the current Trump administration and even the Biden administration had pretty tough sanctions against Iran. I find it unlikely that the vast majority of those sanctions are going to be relieved. With the prospect of Iran continuing to have a range of partner forces and pretty significant capabilities, but there could be some sanctions relief that comes with any kind of a longer-term deal.
Seth, do you have a sense of how closely aligned the U.S. is with the GCC, with Saudi Arabia and United Arab Emirates and Qatar and the other nations in the region?
Well, I think they are aligned in some ways. I think that, one challenge right now is some Gulf states appear to have openly called for the end of the regime in Iran. That does not look like it's going to take place. The Supreme Leader's son is in power at the moment. The regime is largely the Islamic Revolutionary Guard is still in place. But I do think there is a joint view to get the Strait open. I mean, I think it's the single most important issue I think that the U.S. shares. It's a common interest between the Gulf states and the U.S.
Is there a sense of what it's going to take, Seth, in terms of have we actually taken ground troops off the table? Have we actually taken a further, more aggressive stance in the region and put that aside for the time being?
I don't think we've taken the prospect of using either ground or naval forces completely off the table. They're still in the region. The U.S. has naval ships that could be used. The U.S. also has ground forces that could be used, whether it's to take islands in and around the Strait of Hormuz or on the shoreline of Iran. So I think if the U.S. wants to escalate, if it does not feel that Iran is abiding by any kind of a deal, it could use those forces, either naval or ground, as a backup. I mean, the problem is it'd be risky. You do risk naval forces getting shot at with anti-ship cruise missiles coming from Iran. So there are some risks involved.
Seth Jones of CSIS, thank you so much for being with us this morning. We are getting a Truth Social post from President Trump as we parse through the market moves, talking about what has been agreed on and what hasn't been agreed on. He's saying the United States will work closely with Iran, which we have determined has gone through what will be a very productive regime change. There will be no enrichment of uranium, and the United States will, working with Iran, dig up and remove all of the deeply buried nuclear dust. It is now and has been under very exacting satellite surveillance. Nothing has been touched from the date of the attack, going on and saying many of the 15 points have already been agreed to. This, to me, Alex, is a real key question here, and you raised this as well, talking about potentially tariff and sanctions relief with Iran. That seems plausible. Enriching of uranium, not so much.
Yeah, I think that this has definitely been a red line for the administration and, of course, for Israel as well. It's just that there's no enrichment at all. And, the 3.7% enrichment grade, which is for civilian use, versus the 60% highly enriched stuff, which is sitting somewhere under a pile of rubble, allegedly. Yeah, that's just going to be untenable for the Western world and certainly for Israel. So, I think that actually putting that on the table right away and just making that the red line, I think is important not to lose sight for the market.
Well, meanwhile, the market is cheering the idea of a ceasefire coming up. Rapidan Energy Group CEO Scott Modell with oil seeing its biggest one-day drop going back to the pandemic. This is Bloomberg Surveillance. A sense of calm easing over markets, leading to a roaring rally. You're looking at S&P futures near session highs right now, up 2.8% after some of the gains that we've seen going back to, frankly, yesterday at the close after the 8 p.m. deadline. Meanwhile, the Kospi just closing up 6.9%, surging on the heels of some sort of ceasefire deal and a 5.2% gain on the DAX. Meanwhile, what you're seeing in oil prices is really driving everything. Crude WTI plunging more than 10%, 14% declines on both the Brent and WTI. A real sense of calm. Now getting some more details from President Trump, putting out on Truth Social, saying that the U.S. is discussing sanctions and tariff relief with Iran and talking about some of that 15-point deal, some of the aspects of which have already been agreed upon. 2 hours away from the cash open, here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. The airlines were already up on ceasefire relief, but they are up even higher now after Delta reported earnings. The airline beating expectations with strong premium and loyalty demand, helping to cushion a more than $2 billion fuel hit it expects to incur through June due to the Iran conflict. But this idea that we will see a resolution to this conflict is helping to lift the entire sector, with United and American also up some 12%. Turning to the semiconductor and memory chip stocks, they are also rising. A bit of a relief rally here with the ceasefire bringing investors back into risk and back into this AI trade. And as tensions ease, that could also mean some relief for helium supply out of Qatar. That had been a big concern for the market since it is such a critical part of the chip making process. And we end on the miners, tracking the rise in gold and other precious metals, with gold pushing back around $4,800 an ounce after that ceasefire was announced. So you are seeing names like BHP up 6%, Rio Tinto up nearly 6%, and also Newmont Mining also up. Lisa.
Thank you so much, Yahira. On our radar this morning, as we look to that ceasefire, the U.S. and Iran agreeing to a 2-week ceasing in the fighting. President Donald Trump announcing the deal on social media, suspending all strikes in exchange for the, quote, complete and immediate reopening of the Strait of Hormuz. Pakistan emerging as a pivotal mediator between the U.S. and Iran. Following a public appeal from Prime Minister Shehbaz Sharif, Islamabad will now host high-level delegations from both the United States and Iran this Friday. And NATO chief Mark Rutte heading to the White House today for high-stakes talks with President Donald Trump. The visit coming as the president is threatening to withdraw from NATO due to allies refusing to back U.S. military strikes in Iran. Ongoing questions, Alex, as we look ahead to exactly how this will be resolved. One thing you've been really good about, though, even if you have the best intel on just how complicated the situation is, how global powers are rearranging, that has not influenced exactly how to make money in markets. Why has that been such the case so far this year and, frankly, for the past couple of years?
I think it's a very good question. I'm not sure it's necessarily an easy answer to unpack. My suspicion is that some of it is just naturally the forward nature looking of markets, so they're not necessarily always reacting to the here and now. For example, I think it was it last week or the week before, we had a huge spike in oil one day, and then the S&P was unchanged that day, and everyone was scratching their head. So that sensitivity is changing all the time. The second thing, which I think is really important, is just to think about how the growth in asset management, especially here in the US, hasn't necessarily been directional money. I mean, yes, you've got huge retail exposure and mutual funds and ETFs and whatnot, but actually a huge amount of growth has come from a multi-manager that's just gone from like a 350 billion AUM block to $1 trillion. Remember, that's unlevered, so leverage is orders of magnitude larger. And that's generally running quite risk neutral in terms of it's not necessarily just long stuff, it's long and it's short, running a lot of RV strategies, so that when positions get unwound, it's not necessarily impacting the market in the same way that it would have done when it's just a risk-off correlated one and everything goes up or down.
Which is a reason why people are watching the oil price move, seeing the move in equities and saying, at least in your opinion, things could go a lot higher because people are not positioned for a sustained decrease in some of the tensions globally. And there's a lot of money and liquidity in the system. Yeah,
I think if you've de-risked substantially, your point about liquidity is very valid. We've still got discussion points going on in the background that haven't been resolved, whether it's what's happening with the Fed, what's happening with AI disruption. Remember that? We were talking about that in January.
Don't forget.
We'd love to go back and talk about that and not have to talk about Iran anymore. And there's obviously negatives too, such as private credit, which is still lingering in the background. So yeah, there's a lot of other themes that people are going to have to sort of roll their sleeves up on again. But I think the bottom line is that Iran is just a huge sword of Damocles hanging over the market. Removing some of that just naturally just springs risk back.
Meanwhile, there is a sprinkling of risk still in the market. Another Truth Social post by President Trump saying that any country supplying military equipment, weapons to Iran will immediately be tariffed on any goods sold to the United States of America by 50%, effective immediately. Meanwhile, there are reports coming from Israel that the nation just carried out the largest attack yet on Hezbollah in Lebanon. So both of these things coming together, highlighting the risks that still do remain for the tentative ceasefire, as well as just how much a number of the nations are angling ahead of that. Oil, meanwhile, is still taking their cues from the ceasefire, trading back below $100 a barrel, seeing its biggest one-day drop since the pandemic. Bloomberg's Anthony DiPaolo joins us now. Anthony, thank you so much for being with us. What do we know about any of the ships in the Strait of Hormuz that have been marooned there? How many of them are getting through? What the discussions are like with the Iranian authorities?
Good morning. Yeah, well, so far, none to very few are getting through. We've been watching a few tankers that were linked to Iran or appear to be linked to Iran anyway, that were looking to pass through earlier this morning. There has been a trickle of vessels going through anyway that Iran has been letting through. But in terms of the major bulk of vessels there, that's cargo ships, oil tankers, tankers with refined products on them. Those are still in the Persian Gulf, blocked in behind the Strait of Hormuz, and they're not coming out. So we are watching closely to see what happens with that. But we're getting a lot of skepticism and a lot of question marks from the shippers and from the insurers there. They want more details. They want to know exactly what's going on. Remember, we have this ceasefire based on negotiating these points in these various plans, a 10-point plan, a 15-point plan. And what we're hearing today from the public statements, it seems like it depends on who you're hearing from, what plan they're working on in terms of the negotiation. So we're waiting to get really some clarity on how vessels can go through, what are the security assurances for them, and what are the financial terms? Do they need to pay? Who do they need to pay? How do they need to pay? So really waiting to see that before we see any meaningful movement go through. And that's what we're hearing from the traders, from the shippers. And we need to see that backlog cleared before we can see new oil production ramped up in the Gulf that will add new oil to the market.
Anthony DiPaolo, thank you so much for that from Dubai. Rapidan Energy Group CEO Scott Modell writing, the two sides remain very far apart. Barring a dramatic unilateral concession or an unlikely meeting in the middle, expect a resumption of hostilities when the 2-week window closes. Scott joins us now. Scott, thank you so much for being with us. How do you treat the ceasefire, given your belief that it is likely to be short-lived?
Hi, good morning. Thank you. The ceasefire for us, I think it's very interesting. Our core view at this point is that it doesn't work and it reverses. I think Seth Jones said it very nicely. He laid out several of the reasons why we should be skeptical. The sides are extremely far apart. There really hasn't been an end to the fighting and the shooting. I think that's going to go on. I think the Iranians are very thrilled that that President Trump has said you essentially have control over the Strait of Hormuz. And we're willing to use your 10-point plan as the basis, as a workable basis. I mean, they're overjoyed at that, but they just don't trust really what's coming from out of this White House. I think they're in a wait-and-see mode. When I take a step back and I think about how the market is looking at this, we were on the verge in mid-April of heading towards 120 or 130 or higher as paper and physical markets converged. I think we could easily get back to that because, again, as you said, in our belief, this is pretty tenuous.
Given the ceasefire that is agreed upon, at least tenuously right now, should it last, how high should oil prices remain just based on frictions that are ongoing both in the region and, frankly, the rebuild that needs to go on to some of the facilities in the area?
You know, I think if the ceasefire lasts and we start to see something that looks workable and we start to see something that resembles 20, 30, 40% of pre-conflict flows to the Strait of Hormuz, and we don't see a resumption of conflict, we don't see bombing here or there, whether it's in Israel or Bahrain, then I think you can sustain prices where they are. I think the market needs to see that for a while before we start to either go back to where we were before yesterday, or we start to say, hey, look, it looks like we can actually get a real deal and go even lower. But I think, it's very plausible to see us in this $90 to $100 range for a week or two, as long as we either don't tip over and this thing doesn't crash, or we get a deal. But I think it's very viable that we stay in this price range. But I do think a lot of questions need to be answered before everybody can breathe a sigh of relief and say, now we can actually go back down much lower and where crude will sell off to a place where we will have very little geopolitical risk priced in. But we have a long way to go before we get to that place.
Scott, specifically just on Iraq, obviously there was a deal that was announced between Iran and Iraq before this tentative ceasefire was announced. Do you think that changes the calculus for oil prices at all? Because obviously Iraq was producing 3.5 million barrels, a real swing factor that's coming out of Hormuz.
I don't think it's a major. I don't think it's a major factor, but I do think it's important. Our understanding is that there still are fundamental problems in Iraq that will prevent some production from coming back. But it is a sign that Iran is cutting deals. I think the market steps back and says Iraq not being able to export would have been a very, very big problem. That they were able to strike a deal. I think, one, it was very sensible and rational to see Iran coming together with a country like Iraq. They've worked long and they've worked together and they have a very close relationship. I think it gives some floor in terms of confidence building that Iran is somebody that can reach reasonable deals. But again, there are so many other things swirling around that offset that at this point.
Scott, is there any credence to the idea that any kind of toll paid through the Strait of Hormuz would be done in Chinese renminbi?
There is. I will say this, though, when I step back and we've been looking at this for a long time, people will often ask us, this Chinese-Iranian partnership, is Iran in the, have they bought into the idea that they're about helping China replace the dollar with renminbi? And everything I've heard up until now is not really. They don't want to do that. If they have to, they'll take renminbi. They will go along with it. There is a real partnership there, but look, if they can get euros or dollars, they always prefer that. The Chinese-Iranian relationship, I have to say, there's more to it than meets the eye. It's not a clean strategic partnership, but rather there's distrust at the foundation of it. And I think the Iranians will do what they can to maintain control over the Strait and balance their equities with China and others. But really, when it comes to dealing with China, they're very distrustful also. And I think they say, we don't want to go all in with China. China is a partner of convenience as they've been so severely under sanctions. But if Iran can actually break out and get to a place where President Trump is really easing sanctions, moving closer to a deal, I think you're going to see that partnership change. And I think you'll see more of a balancing act. But in the meantime, I think they will be happy to take Chinese renminbi as they have been for a very long time. But again, it's not the ideal scenario for them.
Scott Modell of Rapidan Energy, the CEO, thank you so much for being with us. Alex, I was looking at the renminbi, and the dollar is the weakest versus the renminbi going back to March of 2023. We saw this huge rise in the renminbi strengthening versus other currencies. How tradable is that, this idea that China has a new face on the global stage and it's being represented in markets?
Well, I think that you have to sort of differentiate between China as a place on the world stage and then China as a capital market that you can invest in. And, as the second largest economy in the world, but actually as a representation of global capital markets, is still a very small percentage. So I think that, from the geopolitical stuff, great dinner discussion. I think that from the market allocation, I think China it is an interesting market. Let's be very clear. But to access it has always been not particularly straightforward. One of the things that we really like with our tactical strategies team out in Asia is actually just using surgical custom baskets within China to access very, very leading edge thematics such as robotics, AI infrastructure, software, and so on and so forth. It's things that you just can't get through the typical index.
So it's not exactly a wholesale sea change necessarily from a market positioning standpoint, but a bit on the tactical side, which is what a lot of people have been pointing to. We'll continue that conversation right now. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Anna and Yahira.
Hi, Lisa. Strikes have been reported across the Persian Gulf despite the announcement of a U.S.-Iran ceasefire deal. The UAE said it responded to a missile threat on Wednesday, and Kuwait saying it's been dealing with intense attacks from Iran throughout the day. Negotiations are still in place, scheduled for Friday in Pakistan, Iran confirming it will attend. Shares of Exxon are falling 5.8% in the pre-market after the energy giant said its global production fell by 6% in the first quarter due to the war. Half of the outages were concentrated at an LNG plant in Qatar that suffered damage. Still, Exxon expects first quarter gains of over $2 billion due to the spike in energy prices. And Moody's cutting the outlook on Blue Owl to negative after, quote, significantly higher than peer redemption requests in the first quarter. The move is part of ratings agency's broader revision of its outlook for private credit investment vehicles to negative. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, reviving rate cut bets.
We actually think that the next move for the Fed is a cut rather than a hike. I would focus less on how bad the growth data is going to be and more about what the inflationary backdrop is.
Earl Davis of BMO joins next. This is Bloomberg Surveillance. The rally continues as people look to a ceasefire that could potentially be durable. We are getting more details from President Trump throughout the morning, talking about all things having to do with a 15-point plan, most of which he says have been agreed upon. S&P futures at session highs, 2.8% gain, a bigger gain on the NASDAQ and Russell 2000, 3.5% and 4% gains, respectively, on futures. In the bond space, 2 years, 10 years, 30-year yields, all of them tumbling on the prospect that there might be less inflation and perhaps less of a reason for the Federal Reserve to have to cut rates, led by the front end of the yield curve, 3.72% in the United States, down 6 basis points, a significantly bigger move over in Europe. Under surveillance this morning, reviving rate cut bets.
We actually think that the next move for the Fed is a cut rather than a hike. I would focus less on how bad the growth data is going to be and more about what the inflationary backdrop is. Does this remain a supply-side driven inflation shock, or does it morph into something that is more sustainable?
Here's the latest. Falling oil prices pulling down Treasury yields. Traders betting easing energy prices can keep Fed rate cuts on track. Earl Davis of BMO writing, we expect the relief rally to last 7 to 10 days on pent-up demand, adding there will be a significant amount of new credit issuance, which should limit the extent of the risk on trades. Earl joins us now for more. Earl, thank you so much for being with us. What do you make of the knee-jerk move, particularly at the front of the yield curve in the United States and in Europe?
Good morning. We actually love it. It provides significant opportunity for an active manager and volatility. And our plan from the beginning of the year remains exactly the same in regards to yields. The 10-year range for 2025 was 390 to 480. 435 is the midpoint. We are better sellers below 435, which means we are in selling mode right now. And we're better buyers above 435, which meant we went long. During the war aspect. The interesting thing with the ceasefire is that it doesn't reduce market volatility, it actually increases it. And the reason why it increases it is because your range now is wider. Instead of trading within a 10-point range on duration, you're now within a 20-point range or 30-point range on a shorter term basis. So for us, we're better sellers here. We do believe we will see if not new highs, we will test new highs because driven by inflation and other aspects of the negotiation.
Earl, do you think that we're going to test new highs more significantly at the front end or the long end as people assess the inflationary push through to the economy and, frankly, a Fed that might be politically incentivized to keep rates lower rather than higher?
Yeah, that's a great question because I could foresee a parallel move. But if I were to bet on one of them, I'd say the long end, but not long end, 10-year yields. And the reason why I say that, the whole move in fixed income right now, like even towards the higher yields, call it 440 and stuff, was all real rate based. It wasn't break-even inflations. We never saw break-even inflation go above 245, where the previous high during COVID was 302. So we do believe the next wave of selling or to make a new high could be inflation driven, which means you have another 25 to 50 basis points of moves there, not real rate driven. So I would say 10 years because of it could be an inflation move, not a real rate or risk premium move.
Oh, what do you think about on the volatility side specifically? Obviously, rate vol has been a big driver for all of cross-asset volatility. So where do you think that's heading in the near term?
Yeah, that's a good question. I think rate vol right now for, let's call it the next week or 2 weeks, will subside a little bit. But overall, as I started our conversation with, volatility now increases. And the reason why it increases, the big driver will come back to inflation. It's not necessarily oil, but it was the secondary impacts of the Strait of Hormuz being closed, which is your plastics, your fertilizers. That comes into food, and we're going to be seeing that in the numbers coming forward in regards to your packaging of goods, your transportation of goods. That could be significant and sustainable. And even if there is a deal, that will not go back to where it was before. And that is the worrisome part. The market is not looking at that right now, and rightfully so, but we do believe that's going to be a big Q3 story, late Q2. So that's what we're looking out for, and that's what we'll be setting up our risk for.
Earl Davis of BMO, thank you so much for being with us. A lot of people looking to CPI on Friday, core PCE on Thursday, personal income and spending. But more importantly, perhaps inflation expectations, given that the Federal Reserve has said that they are going to respond to that. This morning, we've gotten a slew of messaging from the president, the latest coming from President Trump, saying that he is setting a 50% tariff on countries that are supplying arms to Iran, saying it is effective immediately. Alex Altmann of Barclays, what's your takeaway from that, given the fact that the tariff lever is kind of coming into a picture and merging with the Iran war?
So what's really interesting about this, and I'm analyzing it real time as well as you, is that this is just Section 232, which is something which, that's just a bunch of number salads that was with part of all the tariffs that was going on. But if you remember, after the IEEPA Supreme Court throwout, it all went back to 122, 232, 301s, all these random numbers. But 232 was something that was actually used in President Trump's first term as well. And 232 is about national security. So this actually very much fits in that framework. It's already been used on aluminium. And so I think it's a direct strike at China once again as a point of negotiation and leverage ahead of the Trump-Xi meeting next month.
Where does this war, the conflict, the role of the U.S., the role of China, where does it leave the points of leverage going into this negotiation in person?
I think right now the main objective is to be calm between the two superpowers. I think there is effectively an agreed détente. The fact that the president is actually going to China to actually meet with President Xi is a very big deal. And I think both sides ultimately are in a position where they want to maintain sort of this mutual respect near term. Even if we can talk about longer term, there are more structural issues as the US and China decouple. One of the reasons why, as a team, we love the commodity theme is because of this US-China decoupling and that whole every man for himself. It started with US and China, and now I think it's morphing into other regions as well, Europe in particular.
Yeah, Alex Altmann, thank you so much for being with us this morning. Truly a pleasure having you on a day that has been a complete whipsaw versus what we've seen in the prior couple of weeks. A huge risk rally, particularly in Asia and Europe. In the U.S., you are seeing that rally continue with big tech, with the Russell 2000 futures surging, yields significantly lower, and oil prices plunging the most since the pandemic. Coming up in the next hour, Emily Roland of John Hancock, Tom Porcelli of Wells Fargo, Matt Diczok of Merrill and Bank of America Private Bank. This is Bloomberg Surveillance. Good morning.
The amount of downside has probably been less than anyone would have expected.
The market is being very calm about this whole situation.
The drawdowns in equities were not as great as you would expect.
The market is trying to understand what is likely to happen.
Right now, the market is expecting a soft off-ramp.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning, live from New York. Welcome back to the third hour of Bloomberg Surveillance. A two-week ceasefire propping up risk assets around the world with many questions remaining. Some of them, perhaps, will get answered with the Defense Department press conference about to begin any minute. Analysts searching for details to understand the agreement, to understand where the nodes of agreement are, and how quickly shipping can resume through the Strait of Hormuz. Right now in markets, you are seeing that rally continue to session highs, led by, frankly, European and Asian equities. In the United States, it's led by big tech and it's led by the small caps. You're seeing both of those up more than 3.5%. NASDAQ up about 3.5%. Russell 3.9%. Futures in the S&P up 2.8%. Around the world, the gains are significantly higher. The Kospi closing out at 6.9% after being beaten up on concerns about the ability of Asia to get fuel. The Nikkei up 5.4%. The DAX with its best day going back to 2022. European equities up 5.2%. Meanwhile, in the bond space, you're seeing an absolute rush into the front end of the yield curve. In the U.S., you're seeing a 7 basis point decline, 3.72% now on the 2-year. Around the world, the UK and the German bond yields down more than 20 basis points. And all of this hinged on this right here. Oil prices plunging the most going back to the pandemic, down about 15% on Brent, $92.21. On WTI, the June contract, $85 as people look to a potential for ships to start moving once again through the Strait of Hormuz. Coming up this hour, Emily Roland of Manulife, John Hancock Investments, with that surging risk-on sentiment as a backdrop. Tom Porcelli of Wells Fargo with inflation concerns weighing on the Fed, and Matt Diczok of Merrill and Bank of America Private Bank on continuing U.S. resilience. Right now, we are awaiting the Defense Department press conference. It has not started yet. We are so happy, Emily, to have you in the office. Emily, how much are you looking at this risk-on rally as something that could potentially have legs?
I mean, investors have been trained to buy on these dips, and it's happened before conflicts have been resolved. All we have to look back to is a year ago in the height of Liberation Day, where there was this almost panic buying. We used to talk about panic selling for most of our careers, and now we're experiencing this environment where dip buyers are just absolutely ferocious coming into this market, and the risk of war escalating, oil prices staying elevated, were really never fully priced into markets to begin with. So I'm not overly surprised to see this risk on sentiment this morning.
And at what point do you lean into it? And at one point do you say, okay, we could take profits, sit back here and wait for the next shoe to drop?
We haven't made a lot of changes based on the geopolitical headlines. Clearly so easy to get whipsawed there. So we've continued to hold on to high quality assets here throughout the volatility, finding pockets of areas that have been trading at a discount. I'm excited for earnings season to start next week. We can finally talk about something else and bring the conversation back to the fundamentals. Analysts are penciling in 13% earnings growth for this quarter. Kind of a high bar, but we think that companies are going to be able to deliver to some extent on those expectations.
Heading into this, you were a bit more conservative. You were leaning into the debt markets. You were leaning away from some of the more cyclically exposed areas that could potentially get beaten up in some sort of inflationary shock or a stagflationary type of impulse. Do you still see that as the most likely outcome, even with that backdrop of earnings that we're seeing trickle out this morning from the likes of Delta?
Yeah, I mean, we still are positive on risk assets. The challenge is just the starting point. You know, analysts are penciling in, again, after this, it gets even harder, 18, 20% over the next couple of quarters. So the expectations are probably a little bit elevated, but we're still constructive.
Emily, we're going to continue this conversation in just a minute. We are seeing that briefing get started. The Pentagon providing an update to operations in the Middle East. Let's listen in.
Longer. Not on our watch. Other presidents marked time and kicked the can down the road. President Trump made history. From the strike that took out Qasem Soleimani, to tearing up the disastrous Obama-Iran deal, to the precision campaign that obliterated Iran's nuclear sites in Operation Midnight Hammer, to the decisive military victory we just achieved in Operation Epic Fury. No other president has shown the courage and resolve of this commander-in-chief. President Trump forged this moment. Iran begged for this ceasefire, and we all know it. As the President truth this morning, a big day for world peace. Iran wants it to happen. They've had enough. Operation Epic Fury was a historic and overwhelming victory on the battlefield. A capital V military victory. By any measure, Epic Fury decimated Iran's military and rendered it combat ineffective for years to come. You see, in less than 40 days, one of our combatant commands, Central Command, CENTCOM, using less than 10% of America's total combat power, dismantled one of the world's largest militaries. The world's leading state sponsor of terrorism proved utterly incapable of defending itself, its people, or its territory. We untied just a fraction of our strength, and Iran suffered a devastating military defeat. Together with our Israeli partners, America's military achieved every single objective, on plan, on schedule, exactly as laid out from day one. Iran's Navy is at the bottom of the sea, whether it's the Soleimani class, their frigate class, their prized drone aircraft carriers, submarines, mine layers, sunk. Iran's Air Force has been wiped out. Iran no longer has an air defense, any sort of a comprehensive air defense system. We own their skies. Their missile program is functionally destroyed. Launchers, production facilities, and existing stockpiles depleted and decimated. And almost completely ineffective. Iran shot hundreds and hundreds of missiles and one-way attack drones at our aircraft carrier. They were obsessed with it, and they never got even close. Every single one of those shots easily shot down miles and miles away from the Abe Lincoln. They were blowing ammo into fantasy land. Contrast that with, most significantly, in last night's wave of more than 800 strikes, we finished completely destroying Iran's defense industrial base, a core pillar of our mission objective. What little they have left buried in bunkers is all they will have. They can still shoot, we know that. Their command and control is so decimated they can't really talk and coordinate, so they still may shoot here and there, but that would be very, very unwise. But they can no longer build missiles, build rockets, build launchers, or build UAVs. Their factories have been razed to the ground, set back in historic fashion. You see, had Iran refused our terms, the next targets would have been their power plants, their bridges, and oil and energy infrastructure, targets they could not defend and could not realistically rebuild. It would have taken them decades, and we were locked and loaded. They couldn't defend against it. President Trump had the power to cripple Iran's entire economy in minutes, but he chose mercy. He spared those targets because Iran accepted the ceasefire under overwhelming pressure. The new Iranian regime understood that a deal was far better than the fate that awaited them. This new regime just happened to look at what happened to their predecessors. Their top leadership was systematically eliminated. The previous Iranian supreme leader, dead. The Supreme National Security Council Secretary, dead. The Supreme Leader Office Advisor, dead. The Supreme Leader Military Office Chief, dead. The Defense Minister, no longer with us. The IRGC Commander, dead. The Armed Forces General Staff Commander, dead. The Intelligence Minister, dead. The IRGC Navy Commander, no longer here. The IRGC Intel Chief, dead. I skipped over a bunch, and I could go on and on and on, to include the new so-called new Supreme Leader wounded and disfigured. This new regime was out of options and out of time, so they cut a deal. They know this agreement means that they will never, ever possess a nuclear weapon. Under the terms, any nuclear material they should have will be removed. Any material, they should not have will be removed. Right now, their dust is deeply buried and watched 24/7 overhead. The president has been clear from the beginning, there will be no Iranian nuclear weapons. Period. Full stop. Other presidents said it. President Trump did it. Operation Epic Fury. Less than 6 weeks, clear mission, decisive action, overwhelming firepower, America first, a historic battlefield victory. For decades, Iran killed Americans with roadside bombs in Iraq, using cowardly proxies to do their dirty work while they hid safely in Tehran. They struck our embassies with car bombs and attacked from the shadows, never daring to face us toe-to-toe. They thought they could bleed America with impunity. Well, they just learned the hard way what happens when you try to fight us directly. And even when they got lucky, one time in 40 days, and downed 2 of our pilots, they couldn't hold them. In a daring 14-hour rescue operation, 7 hours in daylight and 7 hours of night, both pilots were recovered safely. Not once, but twice. A daylight thunder run right up the middle of their country, boots on the ground. A midnight raid right up the middle of their country, boots on the ground. 0 American casualties. The Iranians humiliated and demoralized. We control their fate, not the other way around. That's why they came to the table. Iran's defeat is America's retribution for every American lost to Iranian terror, especially those brave troops killed by Iranian-made roadside bombs in Iraq that my generation knows so well, and for the suffering their regime has inflicted around the world. Now we have a chance at real peace and a real deal. The War Department, for now, has done its part. We stand ready in the background to ensure Iran upholds every reasonable term. And as everyone knows, nobody makes a better deal than President Trump. To the warriors of epic fury, I say well done. You're the backbone of our country. Your skill, your bravery, and sheer guts and grit showed the world what America is all about. I'm proud of you. We're proud of you. President is proud of you. Job well done. But stay vigilant and stay ready. To the families of our fallen, your sacrifice was in service of a historic cause, and we will always remember your heroes, our heroes. We will continue to honor them. And to our Israeli allies, thank you for being a brave, capable, and willing ally on this battlefield. The rest of the world and the rest of our so-called allies saw what real capabilities look like. They should take some notes. Our troops, our American warriors, deserve the credit for this day. But God deserves all the glory. Tens of thousands of sorties, refuelings, and strikes carried out under the protection of divine providence, a massive effort with miraculous protection. Dude 44 Bravo spoke for all of us. God is good. The chairman will now provide an even deeper military detail on the historic success of Operation Epic Fury. Mr. Chairman.
Thank you, Mr. Secretary, and good morning, ladies and gentlemen. Thanks for being here. I want to start this morning by honoring the 13 members of our American Joint Force who were killed in action thus far during this operation. Their sacrifice and that of their families is deeply important to us, and we are grateful for each of them and will continue to mourn their loss. Their names and their bravery will never be forgotten. On February 28th, the President of the United States ordered the Joint Force to execute Operation Epic Fury with the direction to accomplish 3 distinct military objectives: destroy Iran's ballistic missile and drone capabilities, destroy the Iranian Navy, and destroy their defense industrial base to ensure that Iran cannot reconstitute the ability to project power outside their borders. Over the course of 38 days of major combat operation, the Joint Force achieved the military objectives as defined by the President. We welcome the ongoing ceasefire, and as the Secretary said, we hope that Iran chooses a lasting peace. But as Secretary Hegseth said, let us be clear, a ceasefire is a pause, and the Joint Force remains ready if ordered or called upon to resume combat operations with the same speed and precision as we've demonstrated over the last 38 days, and we hope that that is not the case. I want to congratulate and thank the leadership today at U.S. Central Command, including the Commander Admiral Brad Cooper, the Deputy Commander Lieutenant General Kevin Leahy, the Senior Enlisted Leader Fleet Master Chief Compton, and every one of the component commanders, senior enlisted leaders, and especially the staff down at U.S. Central Command, who does not get called out for any of the credit, but grinds 24/7 to help offer the options that we bring to the Secretary and the President. I also want to highlight the forces in the United States European Command under the command of Alexis Grinkowicz, who protected the western flank in support of CENTCOM. And I want to thank our partners across the intelligence community. Our ability to see and understand what an adversary is doing help us to be as decisive as we must be on the battlefield. And that includes DIA, NSA, NGA, the CIA, and the National Reconnaissance Office, and others. I want to thank the other combatant commands who have thus far contributed along the way to U.S. Central Command. This includes Transcom, Stratcom, Spacecom, SOCOM, and Cybercom, all of whom poured all in support of CENTCOM's efforts. And I want to thank, as the Secretary did, our Gulf partners who fought alongside each and every one of us every day. From the Kingdom of Saudi Arabia, the UAE, Bahrain, Qatar, Kuwait, and Jordan, all who joined us together to defend and protect our people and our assets, and who, if required, stand ready to do so again. And I want to thank my team at the Joint Staff who work literally around the clock in order to help me offer the options that I must with the associated risks to the Secretary and to the President. They are the hardest working people that I know, and I am deeply grateful for their service.
That was U.S. Defense Secretary Pete Hegseth and Chairman of the Joint Chiefs of Staff Air Force General Dan Kane speaking about what just transpired and having a lot of gratitude toward a lot of different players. The takeaway from this is one of completion or near completion and the idea that there has been a ceasefire that has been agreed upon. This is the reason why you're seeing markets flying and the reason why they have stayed at session highs in the United States in pre-market trading across the board. Joining us now for more insight is Bloomberg's Tyler Kendall. Tyler, seemed like something, not necessarily of a victory lap, but it seemed like a real sense of completion.
Well, Lisa, to your point, in this Pentagon update, Secretary Pete Hegseth said that the U.S. has achieved every single military objective, citing tactical successes in degrading Iran's military capabilities and their defense industrial base. He did go on to say, though, that Iran may still, quote, shoot here and there, but that would be unwise as a ceasefire takes hold. The officials were putting a finer point on that post that we got from President Trump earlier on Truth Social, outlining that a potential longer-term agreement with Iran would include, one, no enrichment of uranium, and two, that the U.S. will work with Iran to remove already enriched material. We heard both of these officials saying that Iran will not be allowed to have nuclear capabilities going forward. Now, Hegseth says that there is a, quote, real chance for a real deal and real peace, but that the military remains ready to resume operations if needed. Of course, we had heard from Vice President J.D. Vance, who is now leading the next round of negotiations, calling the truce earlier today, quote, fragile. Lisa, we are still gleaning details on exactly what these negotiators will ultimately agree to. As you well know, it all depends on securing the Strait of Hormuz. But President Trump did float earlier today that the U.S. is willing to talk about tariff and sanctions relief with Iran if an agreement is reached.
Tariff and sanction relief for Iran. Also, though, talking on a Truth Social post about potentially putting a 50% tariff effective immediately on anyone who sells weaponry to Iran. What do we know, Tyler, about that?
Well, at this point, Lisa, it's unclear exactly which authority the administration would use in order to implement such a tariff regime, considering that the Supreme Court had already struck down President Trump's broad-based emergency powers under the International Emergency Economic Powers Act. Though, of course, we do know that there are other tools in the toolkit, and this is the administration likes to say, including those related to national security. We have reached out to the U.S. Trade Representative's office to get more details on whether or not anything is truly locked and loaded that could actually put those tariffs into effect. But it really felt like a message geared towards Russia and China, considering we know that they are at this point the largest backers when it comes to weapon supplies. And Lisa, we can say that there was reporting overnight from the AFP saying that President Trump feels that China actually was a huge player in getting Iran to the negotiating table for this ceasefire. Of course, President Trump is gearing up for his trip to Beijing next month, and perhaps this could be part of some of that leverage, as we know that China played a pretty big role when it came to any potential ramifications from this conflict, since most of the oil that goes through the Strait of Hormuz heads towards Beijing.
Tyler Kendall, thank you so much for that. We're looking at markets that are surging on the hope of a ceasefire taking hold. Emily Roland here with us of Manulife. John, John Hancock Investments. Emily, how much are you looking at a scenario that truly is a parallel to what we saw about a year ago with Liberation Day and then the de-escalation almost around this exact same time last year?
Yeah, I mean, that's certainly what markets are telling us. And, you know, markets never fully priced this in, as we talked about earlier. The idea was that the U.S. was the only part of the world that was going to be impacted by this. If you think about cross-asset performance coming into today, Japanese equities up 7%. They are a massive importer of oil. Emerging market equities up 4%. U.S. small cap value stocks were up 7%. Year to date, high yield bond spreads barely moved. We got up to about 330 basis points, back down to 3%. And meanwhile, you saw these kind of momentum darlings of the past year really surging the most this morning, whether it was the euro, European stocks, the Kospi. Just remarkable. The DAX, as you mentioned earlier, seeing one of its best one-day gains. So we're just sort of back to the narrative, really, of the last 12 months since the market bottomed in the wake of Liberation Day.
What's a haven in this kind of market, given myriad different types of shocks that could be coming down the pike?
Yeah, it's amazing. And I think we learned a lot of lessons about what is a haven in the periods or the days over the last 6 weeks where we did see downside volatility. So we saw that the U.S. dollar was the two things that worked were basically the dollar and energy stocks. What didn't work, surprisingly, were things like gold. We've had a lot of discussions with investors about whether you can consider gold a safe haven or a diversifier against geopolitical risk. And recent history is telling us that maybe not so much. So some pretty interesting cross-asset dynamics playing out here. We suggested that we would look at any backup in rates as sort of a gift to lean into the income that's available in high-quality bonds, and we're certainly seeing that pay off this morning.
Do you think, though, that has legs, particularly in longer durations, simply because we're looking at a global backdrop where every nation is trying to build up their supply chains, their domestic reliance, their infrastructure, and they're going to have to spend money? How much does that act as a overhang, as a potential counterbalance to some of the otherwise bullish sentiment that will be coming into duration?
Yeah, I mean, there are some little pockets of inflationary pressures, as you point to, and, clearly commodities was playing a big role in that. But what I think bond markets aren't sniffing out is some of the disinflation that's coming down the pipeline. We're seeing it in areas like the housing market, the shelter component of inflation finally seeing some relief. We look at things like Zillow home prices, they're about flat year over year. Rental prices are falling about 1.5% across the country. Shelter's 35% of CPI, so it has the ability to overwhelm some of those other inflationary factors. We're also seeing wage growth. I've spent a lot of time comparing this period to 2022. Wage growth was 5 to 6% at that time, and we're about 3.5%. So really not seeing that pocket of inflation showing any strength either.
That said, we are getting earnings, and we're going to get earnings come next week, and they're expected to be very strong. Yeah. Delta came out earlier today. They omitted full year guidance. There's a lot of uncertainty, but they beat expectations, and frankly, they show that consumer demand is strong. They might actually cut capacity in order to keep prices higher, in order to offset some of the fuel prices. I mean, what would you see in earnings that would make you rethink the sort of disinflationary narrative and, frankly, a more muted level of growth?
Yeah, we're looking at the impact of currency on earnings most significantly this Q1 season. And what you're going to see is really helpful comps in terms of the dollar was exceptionally strong in Q1 of last year. And the weakness is going to be really accretive to corporate earnings this year. So you think about 40% of the revenues of S&P 500 companies come from overseas. So when the dollar weakens, that translation effect is really, really helpful. It's almost like a gift. It's a sort of a liquidity release valve for companies when that dollar weakens. Then you look ahead, though, to Q2, Q3, the comps become much less favorable. So I think this upcoming earnings season can be a good one for companies, that being a key element there, but I think it gets a lot harder from here.
Emily Roland, wonderful to have you. Thank you so much for being with us. Emily Roland of Manulife John Hancock Investments, as we look at a roaring rally around the world on the prospect of a peace deal, or at least a ceasefire agreement for the next 2 weeks. Coming up, we've got Tom Porcelli of Wells Fargo with inflation data in focus, core PCE and CPI on deck, and Yahira Anand with your morning movers. Airline stocks very much in focus. This is Bloomberg Surveillance. Good morning. Looking looking at a market at session highs in the United States after a number of different back and forth discussions about a ceasefire. Yes, there have been a number of projectiles, et cetera. However, discussions on both sides seem to have, at the moment, on one hand, a cessation of some of the escalation risk, and on the other, the promise of allowing ships to go through the Strait of Hormuz. Right now, you're seeing equities across the board. S&P futures higher by 2.6%, 3.4% gain on NASDAQ futures. Russell 2000 up 3.5%. Meanwhile, the real drama has been in Europe, both on the equity side and on the bond space. You could see a surge into some of the fixed income products in the front end of the yield curve. In the UK, two-year yields down 25 basis points to 4.16%. In Germany, the two-year yield down a similar amount to 2.48%. In the U.S., a 5% decline to 3.73%. All of this being driven by oil. Oil prices plunging on the prospect to an easier flow through the Strait of Hormuz, down more than 15% for both Brent and WTI. 1 hour away for the cash open. Here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. The airlines were already up on ceasefire relief, but they are up even higher after Delta reported earnings. The airline beating expectations with strong demand from the premium and loyalty members, helping cushion a more than $2 billion fuel hit it expects to incur through June due to the war. But this idea that there is a resolution in sight is helping to lift the entire sector, with United and American also up some 12 to 13%. And as we see oil pulling back sharply, we are seeing pressure on the U.S. Domestic oil players. These names had run up big during the conflict. Occidental up until yesterday up 16% since the war began. Exxon up more than 10%. So you are seeing this reversal today as investors lock in those gains. And another clear beneficiary of the ceasefire is the tech trade. We are seeing names like Meta up 5%, but these names had been hit hard during the conflict as higher oil prices and inflation fears pushed rates higher. But as that pressure starts to ease, you are seeing investors rotating back into this more growthy part of the market. Lisa?
Thank you so much, Yahira. Let's turn to the Federal Reserve. Investors looking for signals from the central bank's meeting minutes due out at 2 p.m. Eastern. Bloomberg's Michael McKee joins us. Mike, is this just ancient history, or is there actually going to be some tangible information that we can glean?
Well, there's always the possibility of tangible, important information that we might get, but this is largely ancient history. It was 3 weeks ago. The war was just beginning, and nobody knew where we were going. We still don't really know where we're going, so it's hard to say that we have any kind of justification for putting any hope on rate cuts at this point. But the markets are starting to price that back in. You look at December, and there's about a 50% chance right now priced into the markets that the Fed will be cutting rates by then. We'll see how that develops over the next couple of weeks, because we've got a lot of data and a lot of work to do on a peace deal as well. You look at what Fed officials were saying during the war, and I guess it's still on officially, but there are about half and half of the Fed officials who are at this point saying we either want to stay on hold or we might be looking at raising rates because inflation is going up. Now, if inflation stops going up, then that group will become smaller. But there's still a substantial number of people who are on the hawkish side and have been, not just because of the war, but because for 5 years they haven't gotten to the 2% target. It's kind of significant as well that there are only two people who've spoken during this interregnum that have said that we should maybe think about cutting rates. Stephen Myron, of course, but he won't be on the Fed much longer if Kevin Warsh is confirmed. And Chris Waller, who said if prices go down, then we can start thinking about cutting rates again. So it's all going to be about what happens with prices going forward. And we have a lot of inflation data coming out very soon. The Fed minutes aren't going to tell us much, but CPI on Friday is going to be very influential in the markets. And we also get PCE tomorrow. The PCE is February, before the war started, but it gives us a baseline for the Fed's favorite indicator. Then we move on to seeing what happens with import prices and wholesale prices. And then we have the Fed meeting on April 29th. Also, Fed's going to be interested interested in what the Michigan expectations for inflation are. Are Americans pricing in higher gas prices for the time being and starting to think inflation will continue? So a lot to look forward to, a lot of unsettledness, but I'm not sure we get much of a guidance out of the minutes today.
Michael McKee, thank you so much. An honest assessment of what we can expect at 2 p.m. Eastern today. CPI data due out on Friday. That will be not sleepy in any way, shape, or form, giving investors the first look on how oil prices are stoking inflation. Tom Porcelli, chief economist over at Wells Fargo, writing, the March CPI report will put an abrupt end to the gradual disinflationary trend in place over the past 2 years. Tom joins us now, and congratulations. It's been a while, I know, on your new seat. But I'm thinking more broadly here, you were in the disinflation camp.
Yep.
Something has shifted.
Yeah.
Why has it so fundamentally shifted, even with a potential ceasefire?
Yeah, so I think what we have to keep in mind is that, you know, if we look at sort of the things that are really sort of putting a floor beneath inflation right now, there's a couple of them. One of them, of course, has been this transportation component, which has just been sort of, you know, enduring, right? We keep on seeing these airfare price increases. And that's been true over the course of the last, you know, sort of handful of months. It's been volatile, to be sure. But obviously now, over the next couple of months, it's very easy to expect that the transportation component, and specifically airfares, will lift inflation. And in fact, you know, come Friday when we get CPI, I mean, that's exactly what I think we should all expect. In fact, we're looking for the month-on-month to increase by a full percentage point, which is sort of an outsized gain, needless to say. But if now all of a sudden here we are at 85 on WTI, if that's maintained, then all of a sudden as you roll into the April report, then all of a sudden you're looking at flat prices from a transportation perspective. So a lot of volatility. But I think, Lisa, it's funny. The thing that we've really tried to drive home to investors is it's not just about this kind of inflation that is really being impacted by Iran. Really, at the end of the day, what's going to really matter, maybe even more, inflation expectations. And inflation expectations, if you look at the 5-year forward in inflation swaps, if you look at the 5-year forward measure, or if you look at the 1-year forward measure, they've been incredibly stable. So I think that really actually sort of will lend some comfort to the Fed and why we've continued to expect the Fed to cut rates.
I love Cameron Dawson's comment of New Edge Capital. She came on earlier and she said, find someone to believe in you the way that the market believes in the Fed reaching its 2% inflation target. Is there going to be a certain point where markets realize, you know, if we haven't had a 2% inflation rate going back more than 5 years, and there's no real hope of it in the near term, that we're just essentially giving it up for good?
You know, and so this is part of a much bigger conversation. I will be very, very brief on this, or brief for an economist. So I actually hate the target. I hate that there's a 2.0% target, mostly because, one, it sort of borders on hubris to think that you can actually hit 2.0% with any degree of precision over any long period of time. I mean, we spend a very limited amount of time at 2.0%. I think the RBA, the Reserve Bank of Australia, actually has a much better approach. It's a range. That, to me, is a sort of a better way of thinking about it. I think bringing it back to the Fed, I think what they are going to sort of come to grips with, and I think this process is already underway, is that if you are sort of, in the 2% zone, that's going to be enough for them to feel comfortable. And by the way, if anyone needs sort of the proof in the pudding on that, the Fed still has cuts built into their SEP. So even with inflation north of their target, I think it's more about what's going on beneath the surface. And you and I have talked about this many times over the last year or more. If I just swap out OER for something like Zillow or apartment list rents, you're already below target.
Well, putting that aside for 1 second, a lot of people are coming into this situation, seeing the war in Iran and saying this is going to add not only a risk to inflation to the upside, but also to growth to the downside.
Yeah.
And this is sort of the key question mark in a lot of people's minds, especially as we get earnings like the one from Delta, where they're outperforming and they can increase prices. They're going to cut capacity to do it, but they are going to maintain some of their profit guidance.
Yes.
Given that, I mean, where's the stag? And are we looking at a situation of just inflation that's significant with above trend growth for a prolonged period of time?
So I'm a fader of the stag part of this. I think what we have to bear in mind is that before Iran, we actually had fiscal tailwind, right? That was going to be very notable. In fact, we actually would have argued that pre-Iran, you were looking at 3% growth in the United States this year, right? Like we were well above consensus. We'll pare that back a little bit, just given what's happened over the last couple of months. You're still going to be sort of well above what I think consensus probably still is. So the question that we had been asking ourselves over the last couple of weeks was it going to remain, this fiscal stimulus, was it going to remain a tailwind, or was it going to be a shock absorber? right? Because the longer that this endures, right, the longer energy price increases remain, the more it becomes a shock absorber. But if this is the exit ramp, right, if we actually have found an exit ramp, which is an open question, but if we have found an exit ramp, then you still get the fiscal tailwind part of this, and you can actually have a pretty good growth year.
How much is this also predicated on true productivity gains coming from the likes of AI? There was a study that was put out by the Fed showing that the population has shrunk for the first time, or the most, going back to the 1950s. And ultimately, you cannot have an economy that grows at the same pace that it has traditionally if you have a shrinking population, unless productivity really picks up. I mean, how much is this all just predicated on the AI promises?
So I would say productivity is going to be a critically important part of this entire conversation. Is it critically important today? Actually, I would argue that one of the key reasons why we're actually seeing productivity improvement, I mean, just think about what productivity is, right? The math on that is very basic. It's basically output minus hours. Output part has actually been doing, sort of decently well, as we all appreciate. The hours part, though, has been getting clobbered. And that has been flattering productivity, I think, in ways that is really underappreciated. So you're getting the productivity lift that actually, we would argue, has very little to do with what we're seeing from a tech spending perspective, whether it's AI or otherwise. But as we continue to move forward, there's almost no question that you're going to see this sort of AI really kick in. But I want to stress something. If I look at AI usage by sector, and I look at job hiring by sector, and I put that on a scatter chart, you know what it looks like? It looks like someone sneezed on the page, which, statistically speaking, means there's the R is 0. So you're not actually seeing that kick in yet. That's actually waiting for us. Right now, it's actually more of just an improvement based on a reduction in hours.
At this point, a lot of people are also wondering how isolated the United States is from the rest of the world on a lot of different levels, but when it comes to economic trajectory as well. People looking at the likes of Asia and Europe and potentially any importers of oil, and even if there is some sort of ceasefire, oil prices are going to be higher. How important is it for the U.S., for the rest of the world, to be growing at a rapid clip, or at least not contracting, which some people have started to game out based on higher commodity costs?
Yeah, and that's why I think it's important to sort of, for all of us to know, is this really the exit ramp? Because the reality is, in the United States, the Fed benefits from having dual mandate, jobs and inflation. The rest of the global central banks do not have that luxury. They basically have to focus on inflation. So the exit ramp is important because you're talking about hikes in other countries. Again, we were faders of the hike idea in the United States and and that remains the case for us. But the more that you actually will see that upward pressure on inflation that puts upward pressure on short-term rates, the more that the growth differential, U.S. versus everyone else, will favor the United States.
Interesting. Tom Porcelli, wonderful to see you. Thank you so much for being with us.
Thanks, Lisa.
Tom Porcelli, Chief Economist over at Wells Fargo. Right now, let's head over to Yahira Anand and get you an update on stories elsewhere this morning. Hey, Yahira.
Hi, Lisa. The White House wrapping up a briefing on the ceasefire just moments ago with U.S. Defense Secretary Pete Hegseth saying the campaign was a, quote, historic battlefield victory and the military has done its part for now. He says the ceasefire means Iran will never have a nuclear weapon. Vice President J.D. Vance arguing that Iran developments are good, but warns the truce is fragile.
If the Iranians are willing, in good faith, to work with us, I think we can make an agreement. If they're going to lie, if they're going to cheat, if they're going to try to prevent even the fragile truce that we've set up from taking place, then they're not going to be happy. Because what the president has also shown is that we still have clear military, diplomatic, and maybe most importantly, we have extraordinary economic leverage.
Vance wrapping up his remarks in Budapest this week, adding the U.S. achieved what they wanted, which is the reopening of the Strait of Hormuz. And here, PIMCO is in talks with Bank of America to help finance a massive Oracle data center in Michigan. Sources telling us here at Bloomberg the deal could involve roughly $14 billion in debt. If completed, it would mark PIMCO's second major data center financing in under a year. That's your Bloomberg Brief, Lisa.
Thank you so much, Yahira, for everything this morning. Up next, setting you up for the day ahead. Plus, Matt Diczok of Merrill and Bank of America Private Bank on renewed U.S. optimism. From New York, this is Bloomberg Surveillance. Good morning.
Operation Epic Fury was a historic and overwhelming victory on the battlefield. A capital V military victory.
We hope that Iran chooses a lasting peace. Let us be clear, a ceasefire is a pause, and the joint force remains ready if ordered or called upon to resume combat operations.
That was U.S. Defense Secretary Pete Hegseth and Joint Chiefs of Staff Chair General Dan Kane as we assess the state of the ceasefire, what the conditions are, what still needs to be determined. There is a huge rally in risk assets around the world as people assess just how much this reduces some of the escalation risks in the U.S. You do see futures inflecting higher, led by the tech sector as well as small caps, both higher more than 3.4%. The S&P futures higher by 2.6%. In the fixed income space, if inflationary risks are at least tempered by the idea that maybe this conflict will not go on for too long, the Fed not necessarily on the hot seat, yields significantly lower, particularly at the front end, down 6 basis points to 3.73%, and across the curve. All of this predicated on the big driver, which is oil. Oil prices plunging more than 10%, both Brent and WTI now down more than 16%, as we assess what this looks like for ships trying to resume passage through the Strait of Hormuz. Counting down to the opening bell, here is the trading diary for the week ahead. 1 p.m. Eastern, a White House press briefing. At 2 p.m., the Fed meeting minutes, which, as Michael McKee told us, are ancient history. At 3:30 p.m., President Trump meeting with the Secretary General of NATO. Thursday, another round of jobless claims. PCE data also coming out. And Friday, CPI and University of Michigan sentiment survey. Watch that space for inflation expectations among consumers. Turning back to our top story, the U.S.-Iran ceasefire pulling oil prices and Treasury yields lower. Traders now betting easing energy prices can keep Fed rate cuts on track. Matt Diczok of Merrill and Bank of America Private Bank joins us now. Matt, great to see you. Thank you for being here. How much are you reassessing just what the Fed can do and, frankly, how much momentum the U.S. economy can continue to have through the remainder of the year?
So we always thought the idea that the Fed was not going to cut rates at all this year was probably a step too far. That's probably the worst it would be, but that was probably unlikely. So we've moved out officially our projection for probably 2 Fed cuts this year, 2 cuts this year still, pushing them back in terms of the time frame, probably 1 in September, maybe 1 back end of the year. It's probably somewhere between 1 and 2, but we always had the idea that the move up in rates based on this shorter term oil price shock was not going to be a reliable indicator. And when you got to real yields at close to 3% on the 30-year tips, over 2% on 10 years. When you saw the short end sell off, we thought that was an opportunity to add some duration risk, add some fixed income risk. Right now, again, hoping the ceasefire holds, that seems to be correct.
There is some reporting from Iranian state TV that the first ship has passed through the Strait of Hormuz since the ceasefire. There still is an expectation in markets, though, that prices on oil will remain elevated, that this is not the end to some of the inflationary pressures coming from the physical world as people stockpile and try to have greater domestic security. How do you factor that into your expectation of 2 rate cuts and a Federal Reserve that still is amenable to the idea of easing policy?
Yeah, and again, the official forecast is for 2 cuts, but the economics team at Bank of America recognizes that's aggressive, and that certainly could change. It's unlikely that the data is going to be that clear moving forward. These supply logjams take time to work themselves through. But again, the idea that just that energy prices going up isn't necessarily inflationary for the economy as a whole, we take a little bit of challenge with that. Gas prices go up, for people to spend that much on gas and everything else is unlikely. They probably have to cut back spending elsewhere. So sustained energy price increases could actually function like a rate hike. They can create demand destruction for other areas of the economy. So in order for people to spend as much on gas if oil prices stay this high, they would either have to dip into COVID savings, which they don't have, they'd have to use their real earnings growth, which is not that great right now, or they could borrow against assets like their home. They could fund consumption with borrowing like we did pre-financial crisis. We're not seeing them do that. So we're not seeing sustained inflationary pressures economy-wide just from one sector of the economy going up, whether it was energy prices or tariffs. Prices in one sector don't necessarily have to lead to inflation-wide increase across the whole economy, which is why we were conservative. I'm expecting no rate cuts this year. We thought that was a step too far.
That said, we're seeing earnings from the likes of Delta coming out this morning and painting a picture of resilience and painting a picture of enough consumers, maybe not all consumers, but enough of them having the discretionary resources to go out and spend money. They're cutting capacity, charging more money, and there are people who are willing to spend that. At what point do earnings potentially paint a picture of resilience That does mean that some people can absorb those prices, and you can see that sort of persistence in terms of inflation.
And we do see that resilience. You can see it in the manufacturing data, ISM. You can see it in the services data. You can see it in retail spending. You can see it in the recent jobs report. There is amazing resilience for this economy. Again, if you can't come into this environment with perfect information about what would happen, people would probably not guess the S&P would be down 2 or 3% from its all-time high. The durability and the resilience of the U.S. in face of crises, even in crises that we ourselves somewhat cause, is quite incredible. We are, again, relative to the rest of the world, situations like this highlight the resilience of the U.S. economy and the durable, competitive, unassailable advantages the U.S. has, whether it's demographic, whether it's educational, agricultural, resources. We have so many advantages, and that's coming through in the U.S. economy. You're seeing that.
What's your top trade after the ceasefire, given some of the momentum that you're seeing behind fixed income right now?
For the individual investor, we would be looking at municipal bonds, particularly longer out the curve. You can get on a tax equivalent yield over 9% on long-dated investment-grade municipals with no leverage. That is a pretty attractive tax equivalent yield. Again, we find real yields to be generally attractive here, both for individual investors and for institutional investors. So we're not that concerned about duration or interest rate risk. We think it's a good time to add and stretch out a little bit there.
Matt Diczok, thank you so much for being with us. Matt Diczok of Merrill and Bank of America Private Bank here with us. It has been a busy day in Washington ahead with a White House press briefing and President Trump's meeting with the Secretary General of NATO. We're also getting headlines about a first ship passing through the Strait of Hormuz. The Financial Times, though, reporting that Saudi Arabia's crucial east-west pipeline was hit by a drone attack. Bringing it all together to understand what the state of play is Bloomberg's Tyler Kendall. Tyler, it feels like it's moving very quickly. What's the latest in terms of the ceasefire and what details we're finding out?
Hey, Lisa. Well, at this point, actually, a person familiar with the matter just confirmed to Bloomberg News that Saudi Arabia oil pipeline that goes to the Red Sea was indeed hit by a drone attack. At this point, the damage is still being assessed as we wait to glean further details. We haven't gotten any further confirmation other than that, or a response from the White House at this point, as this ceasefire they would like to see ultimately take hold. But of course, we had heard from Vice President J.D. Vance earlier today that the truce at this point is, quote, fragile. Still, in this briefing earlier this hour from Pentagon officials, they are maintaining that the U.S. has achieved its full military objectives in Iran, and they are moving forward with this short-term agreement. President Trump so far has outlined some of those key demands that the U.S. thinks it can get in a deal, including that Iran will not be allowed to have any nuclear capabilities and that the U.S. will work with Iran on extracting the enriched material that is already inside the country. There's going to be a lot developing today at 1 p.m. Eastern. We will get that update from White House Press Secretary Caroline Leavitt, but I'll also put on your radar, as you mentioned, that President Trump will be meeting with the NATO Secretary General Mark Rutte, considered to have a relatively warm relationship with President Trump. But of course, the transatlantic alliance has been strained over this conflict. I think we will hear a lot more about the Strait of Hormuz, as President Trump has previously ramped up the pressure on allies to help make sure that that waterway can get opened.
Tyler Kendall, wonderful reporting throughout the morning. Thank you so much for that. We are seeing markets continuing to stay near all-time highs for U.S. equities, futures and S&P up 2.7%. Oil prices still plunging more than 14% on the heels of a ceasefire. Coming up tomorrow, we've got Keith Lerner of Truist, Bob Michael of J.P. Morgan, Jill Carey Hall of Bank of America, and Michelle Weaver of Morgan Stanley. This was Bloomberg Surveillance. Good morning.